off to a great start, and I encourage everyone to continue using the breakout sessions to discuss possible areas of collaboration. At the same time, we're looking ahead to the 8th annual forum next year, and we'll start the morning with an exciting announcement. At least I think it is exciting. With the full support of our friends in Singapore, next year we'll take the forum to a new country, India. From October 13th to the 15th, 2026, we'll gather in New Delhi with the cooperation and support of Prime Minister Modi. The Prime Minister has commended both the 60-year friendship between India and Singapore and the success of the forum, and I'm glad to report that he's looking forward to welcoming us. We're already looking forward to the involvement of leaders here in Singapore at that forum, and we'll continue to grow and expand our network of partners. And we're confident it will be another productive gathering. First, though, let's hear from a good friend of the forum and of mine. She's somebody I've known for a very long time, Gina Raimondo. If you're not familiar with her full resume, it's very impressive. Harvard, Yale, a Rhodes Scholarship, a stint in venture capital, and before running for elective office and becoming one of the most effective governors in the United States. And that's how our paths first crossed. She was independent-minded, no-nonsense, pro-business, my kind of leader. As Secretary of Commerce under the previous administration, Gina led the charge in supporting economic development, including helping by passing both a major infrastructure bill through the U.S. Congress and a landmark law that helped strengthen America's chip industry. She has a long friendship in bringing government and business together and getting big things done, and that's made her an ideal leader to participate in this forum, and we're glad that she agreed to co-chair the forum's advisory board. Excuse me. She's also been very active in helping to shape this year's program, and all of us on the Bloomberg team appreciate her partnership. Yesterday, I did have the opportunity to sit down with Gina and a diverse group of trade ministers and CEOs, and it was a fascinating conversation. I'm glad our full forum audience now has the chance to hear from her. So please help me in welcoming Gina Raimondo.
Good morning. Good morning. It's wonderful to see everybody. Thank you, Mike. That was a very kind and generous introduction. We were chatting backstage, and it wasn't clear that it was going to be that friendly, so I appreciate that. Anyone who knows Mike knows what I mean. The truth is, Mike and I have been friends for decades, and I admire him so much because of the way he led in his public service. He didn't have to. He left an incredible career and chose to serve and did it as a model public servant, I think. So when he asked me to do this, of course I said yes, because we're friends. But the truth is I knew that if we did it together, he would drive impact. And plus it would be fun. So that's why I'm here. And I couldn't be happier to do it. But the truth is also, in addition to Mike, I believe deeply in what this community stands for. Collaboration across borders, across sectors, to solve the toughest problems we face. And it's fantastic to be with you. Many are friends, some new friends, and I'm excited to see what will come out of this gathering. It's also great to be back in Singapore. Whenever I'm in Singapore, we heard from the Prime Minister last night, who I thought was fantastic. Whenever I'm here in Singapore, I leave more optimistic than when I arrived. Singapore, to me, is a city that proves openness and innovation can coexist with discipline and purpose. And I also think it's a model of what can happen when the public sector works together with the private sector. If the public sector and the private sector pull in the same direction, which is what Mike tried to achieve as mayor, I tried to achieve as governor, we could solve any problem. And I frankly think the U.S. could learn a little bit from Singapore's experience. Okay, I have one primary message for you this morning. My message to all of you here, business leaders from around the world, is that America still wants to work with you. Trust me on this one. Trust me on this one. I know the messages coming out of Washington can sometimes be unsettling, confusing. But I talk to businesses, entrepreneurs, citizens of America every day. They don't want isolation. They do not want isolation. Relationships still matter. The bonds that tie our companies, our universities, our entrepreneurs together, these relationships are personal, meaningful, and resilient. And the truth is they've been tested over decades, and they endure, and they will endure now. Why? Because they've been built on trust, a belief in shared opportunity, and a history of working together successfully to solve problems. I'm sure you've heard the new slogan, America First. You've gotten that memo. Don't confuse it. Don't confuse America First with America Alone. Listen, I have stood for elections many times, all tough elections. When you govern the way I do, it's tough elections. America First was born out of real frustration in our country, okay? America First was born out of the fact that in many communities in our country, whole states saw their factories closing, their livelihoods eroding, and their dignity slipping away over decades. And that pain was real. That pain was real, and it deserved a response. By the way, we live that pain in my family. I'm from Rhode Island, heavy manufacturing state. My dad, when he was 56, after working 30 years at the same factory, lost his job, unceremoniously dismissed. It doesn't feel good, it's hard. And he never, really had a good job again. So it's appropriate, you can understand that we would have to give that a response. So, some amount of reindustrializing, some amount of bringing back critical manufacturing to the U.S., it's necessary. And by the way, it's healthy. It's healthy for America and for the global economy. A strong, innovative, productive America is a good thing. It means we're a better partner, not a weaker one. And every American business I talk to knows this. That's what I want to reassure you of. Every American business knows this. So yes, we will continue to invest in manufacturing, strengthening supply chains. But also we want to do that with you, with our partners around the world. We want to compete, but also be resilient. The area I know best is semiconductors. I know more than I ever thought I would know about semiconductors. And in that instance, when it takes American capital, Asian know-how, and European technology to manufacture the most advanced semiconductors, that's not dependency, that's durability. That's what we want to achieve, that kind of globalization. When American companies work on clean energy solutions in Asia, together with local entrepreneurs, that's shared growth. That is a good thing. When our universities, some of the best in the world, researchers and investors collaborate to fight disease or test the boundaries of physics, that's also a good thing. That fuels progress. I was a commerce secretary, best job I ever had. You're all in commerce. Commerce isn't zero-sum. Sometimes politics is. Commerce is not zero-sum. It's the connective tissue that keeps the global economy alive, creates jobs, spurs growth. So even though the political winds have shifted at the moment, and I do believe it's temporary, I believe it's a pendulum and will swing back, it's on us. I would issue a challenge to all of us here, including myself, to step up right now as governments, as business leaders, investors, educators, innovators. Do what you can to steady the course. I think this moment is a test. It's a test for all of us who believe in connected, rules-based, opportunity-driven global economy. The reality is security and resilience don't have to amount to isolationism and a global retreat. Let's do both. Let's strengthen our supply chains, manufacturing, and workforce at home and collaborate abroad. So if you take one thing away from my comments, I would urge you all, double down on the partnerships. Double down on the partnerships that you create here, that have endured for decades, and by the way, that will also endure this political cycle. Right? The partnerships we have, the commerce we do, what we do together will endure this political cycle. And I also believe, look at the challenges we have to solve. Climate change, global health. We will not solve these problems. Food security and insecurity. We will not solve these problems unless we collaborate as among countries. So don't let the combative politics that we have now all around the world and in our country define this global conversation. If commerce leads, we all win. Yeah? If commerce leads, we have a shared prosperity. And I want to tell you, and I'm sure Mike would agree, and many of you are American business people here, the average American has not changed. The average American entrepreneur, business leader of businesses small and large are the same. We're creative. We're risk takers. We want to succeed. And most of all, we believe in openness. So let's collaborate faithfully. Let's compete, because that's when that happens, the world gets along better. So thank you, Singapore. Thank you for hosting us. Thank you for sharing that spirit of partnership. And thank you to my dear friend Mike for bringing us all together. I mean, Mike brings the world together to solve problems, and I think it's incredible. So thank you and have a fantastic day.
Please welcome to the stage Raphael Arndt, CEO of the Future Fund, Adena Friedman, Chair and CEO of Nasdaq, and David Vélez, Founder and CEO of Nubank, for a conversation with Bloomberg's Stephanie Flanders.
So Gina was just saying we get together to solve problems. We're just going to fix the future of capitalism in this session, or maybe just take a bite out of it. When you study economics, the textbook that you have, the first chapter introduces students to the market and the state. Then there's a bunch about supply, demand, goods and services, savings and investment, elasticities, all those things. But it keeps coming back to that line that you draw between the market and the state. How the market can work with the state to produce the most productive use of resources, but in a way that also makes people feel that it's working for them. And we keep coming back to that in one way or another at these forums, and I think we're going to keep sort of taking bites out of it. But I want to think about that balance and how we're sort of shifting our ideas of how a market and state can work together, particularly when it comes to the financial markets. which is so important to many people in this room. And we have this terrific panel to think about how we can build resilience, make people feel more engaged in the financial system, and sort of just produce better economic outcomes. Let me start with you, Raf, and you have asked me to call you Raf.
Yep.
You're in a really interesting position because you are investing on behalf of, investing public money, the Australian Sovereign Wealth Fund, and the conversations we've had, I know you've had a really an evolution in how you think about that job and how, as you scour the world, what you're looking for in that right kind of balance between market and state and a healthy economy for investors. So just talk us through a little bit of that.
Yeah, thanks. So I guess I sit in the nexus of, I'm a public servant, I work for the government, and I work in financial markets. So
you're the perfect guest for the Economy Forum.
You know, maybe the invisible hand's a bit too invisible at the moment, I think. Like this system we've got is for sure the best system there is to allocate resources, create jobs, grow wealth, grow the pie for everyone. But it's far from perfect. And if you look back at human history, firstly, I'd say capitalism hasn't existed for very long in its current form. And secondly, it doesn't get things right very regularly in terms of it moves forward, it moves back, governments regulate more, less, people feel they're participating or not. We're certainly better off than we've ever been, and my colleagues here on the panel are examples of how we get the benefits of the financial systems out to the people. But I think one thing we've observed is we're moving into a phase now where, because of the huge leveraging of the economy really since World War II, and because we've had a series of crises in the last 20 years where the solutions have made rich people richer but not necessarily made young and working people participate in that, there's a rising view of inequality right around the world. And that's leading to more populist policy, more intervention in markets, and in general, that's a bad thing. It leads to lower growth, a smaller pie, more inflation, and that's not good for society. So we've been thinking quite hard, one, about how to invest into that world. You talk about resilience, but two, about what can be done to smooth that effect so that markets, governments step in the right way, but they don't break the system.
And where, just to follow up on that, I mean, where are you seeing that? What kind of, because obviously you, as an investor, you also just want to get the highest return for Australians, but what have you seen that seem to be helpful interventions to sort of make people feel there was more confidence in the system?
So I come from Australia. It's a great example. It's got amongst the highest median household net wealth in the world. I think it's second. Why? Because we have a compulsory savings system in superannuation. It's been around for 40 years now. That means everyone who works in any job has to put money away for their retirement. My 24 and 21-year-old kids, who are both in casual jobs, are already saving for their retirement. And not only that, they had to pick which fund to go with, so they did some research. So they've engaged with it. They get a statement every quarter. That makes a big difference. But I also think governments need to treat their constituents as educated grown-ups. You know, there's too much of this populist taking advantage of bias and short-termism, and we know that leads to poorer results. And so one of the things we've tried to do, we feel like as a government investment fund, it's our job not just to invest well, but to help everyone get better together. And so we've started to issue discussion papers on the issues we see in the world, the fundamental change that's going on, what that might lead to, and what can be done about it.
Okay, David, I wanted to go to you because you know you've created the Nubank, and obviously in an environment in Brazil and Latin America that has a large number of unbanked, has potentially a lot of suspicion of financial products or just an exclusion from the financial system, and yet the bank has done extraordinarily well and democratized financial services for so many people. So how do you think about that, and what do you think some of the lessons are of the experience?
Sure, and I was thinking about the topic of the panel, and my answer related to this or specific example is capitalism needs a reboot in the direction of more capitalism, not less. And this is, I think, a good example of why I would say that. Across Latin America, you had 300 million people completely outside the banking system. And a lot of people tried to access it, they couldn't get it. Banks had no interest in serving consumers. There was effectively a banking oligopoly in every market. Today you see around the world, this is actually a global, 5-6 banks owning 85-90% of the assets. So when you have that oligopoly, that means capitalism is actually not working, there is no competition. And some countries in Latin America decided that they wanted to use government banks to try to include all of these people into the financial services. That actually did not end up working. It was too expensive, people were not included, the government banks were not well managed. The flip side, what Brazil did very well was the regulators saw we need more competition, technology, smartphone penetration around 2013 are creating this window of opportunity to bring more entrants, more startups, fintechs to compete with this big bank oligopoly. And they set up some very clear regulations and very well thought infrastructure about digital payments. And in our case, in 12 years, we've been able to bring over 40 million people to a banking system. We have contributed to decrease that concentration in the fee banks from 85% to 65% over 10 years. We've saved over $50 billion in fees that consumers, 100 million consumers were paying to that big oligopoly. Now it's being distributed to more competitors and it's being still saved in consumers' pockets. And ultimately, interest rates are coming down, financial inclusion is increasing, customer service is improving. So here, a shock of capitalism, where the government doubled down on more competition and fought that oligopoly, ended up delivering for the majority of the population. And I see that as a really good example of the role of the private sector and the public sector. There is a role for both. The government created this very clear regulatory environment and infrastructure, and then they let a lot of people go compete, created a market, and the best people at providing that service were able to win.
I mean, obviously, whole books get written about the regulation, financial regulation, and how to balance that with allowing innovation. And you've presented it as a perfect example. It sounds almost too good to be true that the regulators would have hit on just the right amount to prevent any kind of problems coming from that kind of innovation. You know, usually, particularly in finance, you have a wave of innovation that produces enormous benefits, but there are a few crashes along the way. Latin America, we've had financial crises that have come after a period of great innovation or opening up of economies. So how was that avoided, or what mistakes have been learnt? Sure,
yeah, and I think you're totally right. So regulators always discuss or think about the balance between systemic risk and competition. And historically, due to the cycles, a lot of the focus was on systemic risk. And that meant prioritizing 4 or 5 banks that own effectively the entire market. You end up hurting access, you end up hurting a competition on that front. There was a change in view for regulators in the case of Brazil. We're saying, well, it's time to bet more on competition and let more people enter. And as 40, 50, 60 different banks went in and competed, there were certainly some that didn't work out. There were some bank failures, small bank failures, but it happened. That's part of capitalism ultimately, this creative destruction, right? You're going to have some big wins, you're going to have some failures. There's got to be a sense of enabling or allowing a number of failures, because otherwise you wouldn't get the big successes. But the flip side of that is the understanding that a very concentrated market is safe. It's actually also a misunderstanding, because you end up with this too big to fail type of bank. So while you have the appearance of systemic or low systemic risk on having a lot of concentrations, you end up having situations like you had in the US with the big financial crisis, where you end up with too big of to fail type of bank. So there is the right sense in the middle. Probably both extremes are careful. What you see in crypto, for example, in our areas of the world, a lot of fraud, a lot of entrance, a lot of speculation. That's probably too much on the extreme of too many people coming in. There is a right balance, but certainly a lot of the answers in some of these lacks of access is more competition, is more entry versus government trying to deliver products or services that the private sector should be trying to deliver.
I mean, Adena, you're sitting at Nasdaq. Obviously there's a context now in which we're talking about public-private, and this is the difference between public and private takes on a different meaning these days when we have private markets, and private capital has become such a huge feature, and we had Mark Rowan on the stage yesterday. How do you see the sort of more traditional end of public capital markets being part of this approach and trying to sort of build people's trust in the system?
Well, I think first, I think it's important to recognize that the public markets are the most accessible markets in the world. So if you want to engage the entire population in the economy, then the public markets need to be vibrant and accessible to them. And you want to have companies want to go public so that they can, so that every citizen in a country has the opportunity to be an owner of those companies. And that is really, what public markets are there to create for the economy. And I think as a result, we've thought a lot about what is the public company experience that we should have, how much regulation is the right amount of regulation for a company to go public and be public, how much regulation, and how do we think about investor protection and making sure that there are proper rules of the road for every player in the public markets to be able to operate, but also keep the investors always in the front of their mind. And I think that's where that balance of regulation on both issuance and the public company experience, as well as on trading and the public, the public investment experience, is the most important, one of the most important roles the government can play. I think that in the United States, it has been interesting. I've started at Nasdaq 32 years ago, so I've been part of the growth of the economy and part of the growth of Nasdaq for many years, and I've seen a lot of different, I would say, cycles in terms of regulatory oversight. And it's hard to strike the right balance. If you think about a public company, they are beholden to their owners, and their owners are shareholders, and their shareholders are every citizen in the world. And they deserve to have the right to information. There should be some transparency that every investor gets to have at the same time, so that there's no, inherent bias or advantage that any investor has. You want to make sure that there's proper liquidity so that you can get in and out of those companies freely. You can make those investment choices at any second of the day, and you can execute those trades successfully. And then you need to have integrity. You need to make sure that there's market surveillance, and that there's trade surveillance, that there's anti-financial crime, and all the things that are necessary and proper rules of the road to make it so investors have the right experience. And that, I think, is what we think. Nasdaq and the U.S. markets are the most liquid. They're the deepest pool of liquidity in the world. And I think that over the decades of a capitalist system, the United States has pretty much struck the right balance. But today, the path to going public is it's like crossing a Rubicon. It is such a huge difference between being a private company and a public company. So how do we start to moderate those rules to give better access to companies who want to go public, who want to access those public investors? Thinking about the disclosure regime, probably there's too much disclosure. There's certain disclosures that are probably not necessary for an investor to make a proper investment decision. There's also the cadence of disclosure. Does every company need to report every quarter, or can there be semi-annual reporting for companies that have certain profiles? Also, then there's the proxy process, which if you ask any company who's public today, one of their least favorite things is the proxy process. And there's, for instance, any individual who owns $2,000 worth of stock, I think it holds it for a year, can put a proposal on the proxy of a company. That's like saying every citizen in the United States gets to put a bill on the floor of Congress and force the Congress to debate and discuss and decide on it. It's democracy, but it's chaos. So it's not. You have to think about what is the holding period and the level of investment that an investor should have before they can actually put a proposal on the proxy. What's the purpose of the proxy? How do you think about the proxy advisors and the role of them and the oversight of them? I think there needs to be more oversight. And then there's the third thing is the litigation environment in the United States. When you go public, you are subject to class action lawsuits from shareholders. And, we have a class action environment in the United States. But you have to say, is there another model that would work better? And the SEC chair has actually had the commission vote to say that for companies going public in the future, you can put in your prospectus that you are going to be subject to mandatory arbitration as opposed to a class action lawsuits. And that is a game-changing opportunity for companies to go public and know that there is an avenue for disputes, there is an avenue for shareholders to have an opportunity to express themselves, but it's in a way I would say that it's more consistent with the public company model. We, as an industry, are subject to mandatory arbitration. So kind of bringing that into the public company model also, I think, is really important. So those are the types of things that create a better balance and make it so more companies want to cross that Rubicon and be part of the public markets.
But, the administration is, I think, has sort of in general had a stance of wanting to liberalise a bit more, potentially could be answering some of your concerns, and also increase liquidity in the market, have more trading, all of those things. There seems to be some support for that. But at the same time, there's also a desire to be very hands-off in relation to things that have inspired some nervousness in crypto and a lot of that innovation. So I just wonder, how do you think about that balance?
Well, what we advocate for in Washington is always what's right for the investor. And we talk a lot about that idea of liquidity, transparency, and integrity. And those are the three ingredients to a successful market, but they need all three. So if you're a private market, then you don't necessarily have the level of transparency and liquidity that makes it so that every investor necessarily is, should have, those investments should not necessarily be available to every investor unless you're able to provide that liquid and transparent model. And then you need to start to think about what are the rules of the road to opening up those private markets to the everyday investors, because they deserve that. I think when it comes to the crypto markets, the SEC and the CFTC, the legislature, they're all grappling with what are the rules of the road that they want to create for this new asset class. Is there a model that harmonizes between a security and a commodity? Are these securities, are these commodities? How do you therefore kind of regulate and oversee them? And there's a big debate that's underway in the United States around that. We're very happy that there is a debate, that there's actually a discussion and a pragmatic way of thinking about how this asset class should be governed and regulated, because it's becoming a big part of the it's a part of the retail investor experience, and there are no rules of the road today. And as you said, that gives rise to a lot of negative consequences. So how do we bring them into a regulated environment while you allow for innovation, but you also put proper oversight and the rules of the road that allow it to investors to have the right experience? And that's the debate that's underway right now.
And just to remind you, I'll have the questions coming through if you want to scan the QR code and offer some questions.
Can I ask, though, did your sons, which fund did they decide to invest in? I've been wondering.
Look, I would just say all of the big super funds in Australia are excellently run. I know all the stuff.
Well, but on that, though, I mean, I had so many questions to ask you, but Raf, if you are looking, and obviously you're thinking in terms of countries as well as individual investments, what your portfolio geographical allocations are. But Adena talks about the importance of integrity, transparency, liquidity in markets. If you look at the combination of those things in the US now, in the mix of US markets and the administration's approach, does that look like a resilient system for you? Do you feel like it's moving in the right direction?
Well, I think that's a leading question, but it's very volatile and unpredictable. And I think, there's a few markets maybe belling the cat, we say, about where we're at in the cycle. One is you talked about litigation funding. Litigation funding is now an institutional asset class. I can invest in litigation funding. Do you think that's a good sign or a bad sign? I'm saying it's a bad sign. Because I invest in the companies that are getting sued too. Mm-hmm. Right? So I think if we just have clear rules, they spread wealth and, as you say, transparency, and people can make informed decisions, that's the point, then we're all better off. Otherwise, we're just paying lawyers, or maybe institutional funders of lawyers. Look, the US has been a remarkable economy and a remarkable market, and it's done incredibly well since World War II. And we have an extremely large exposure. It's almost half the portfolio, and we've benefited greatly from that, as has the world. But the reality is that at the same time that the rest of the world is growing faster than the US, so while the US still has the biggest economy in the world, it's a smaller proportion of the world. Same with the capital markets, except in the last few years, obviously, with the tech boom and AI, we've had a concentration. The rules of the game are at risk and are changing. And for a non-American global investor, we want to know what are the rules around trade, capital flows, taxes, regulation, and they are changing, and they're changing with not much predictability, and that does concern us. And as a sovereign investor into the US, some of the retaliatory tax provisions in the One Big Beautiful Bill Act, which were repealed, really alarmed us. And as a result of that and some of the volatility we've seen around trade policy after Liberation Day, we've already made the decision to reduce our US exposure and have done that and continue to do that. That's not to say that we don't think there are great opportunities in the US. It will remain our largest exposure, but it's just a riskier place to invest than it used to be, and we've lifted the expected return we need as a result.
There seems to me, there is a tension. I mean, we talked about, and I want to sort of keep coming back to this idea of also, you know, some of the populism we've seen, and Raf, you talked about the pressure that's come from the increase in inequality and the people feeling that the system has not worked for them. And the moves that you would make that people might support on this panel to engage people more in the markets are often about making it more accessible, more fun, have people feel like they're engaged in the process. But some of the most fun investments are not necessarily ones that are going to go into the most productive uses for the economy, and they may indeed, you end up getting burnt. So I mean, how does one think about the balance? Because you want people to be engaged, but you do also want there to be a path to long-term investing and not to be having it be completely a game.
Yeah, I think the first thing is access, is people across all different segments being able to know that they can access the equities markets or the fixed income markets or the crypto markets. And I think a lot of the new fintechs in a lot of the different platforms have been able to provide that access. But then that has to come right next with a lot of financial education and products that are very easily to understand. And then there are certain business models that are very incentivized speculation, and that's, I think, when a lot of people end up getting hurt. Incentivizing speculation versus long-term investing. In our case, for example, we have one of the largest crypto platforms and investment platforms in Brazil, but instead of showing 700 different crypto assets, we pick 5. The 5 that we would ourselves invest our money and our kids' money behind, and we add a lot of education and expertise to the different people that are participating in the platform. And so far, I think people have been able to invest and create wealth. But the flip side of that is that there is an instinct to avoid people getting into hurt or buying investing is removing access completely and making it almost illegal, which was what's happening in the US over the past 4 years. Crypto was this asset class that nobody wanted to talk about. Everybody was investing, but it was almost like this, it was effectively a black market. And so there is a balance here. You have to provide access, you have to provide disclosure, but the answer is neither let 1,000 flowers bloom or create black markets or make it illegal, because ultimately people will find a way to get in.
But is liquidity always the answer? I just think you talk about your kids, they can't take the money out. They can be engaged in choosing, but it's inherently a long-term
They can't take, at least under the current rules, they can't take the money out until they're 65. So for my oldest child, that's in 41 years. And, compound interest works. I think one of the issues, we're talking about the issues with the system from within the system. But one of the issues I observe is the capitalist system doesn't really think intergenerationally very well. It gives wealth, or if you take risk, to people who already have it or have built it up through their lifetime. And so how to engage the younger generations in the possibility, but also help them participate, is critical here. Because, we can complain about the regulators, but the regulators, such as we think they're over-regulating, are responding to the policymakers. And in a democracy, they're responding to the voters. And so we need to spread the wealth. We're growing the whole pie for the whole population, and if you can save for your retirement or access funding because you've got an idea you want to start a business or grow a business, that's how you grow the pie.
I think it's important to recognize that there's a role for different types of duration of investing. There's a different type. So, for instance, there's 401ks and there are pension funds that help people save for retirement. The superannuation funds are an incredible creation. I mean, they are an incredible creation. I mean, I think that if we were to kind of restart the United States, that would be a model that we should really kind of lean in on, because it allows everyone to have an opportunity to engage in the economy, to be an owner of the economy for their life. And then it kind of creates that safety net, that kind of nest egg that allows them to know that they can live their lives with some security. And then at the same time, they then have their annual income and they can decide whether or not they want to do things that are in a shorter term, and they want to engage in the markets in a different way and invest in maybe some things that are more speculative, maybe some things that are really exciting to them, maybe some things that are long-term dividend, income generators. But that's what's so great about the public markets, is that you have the opportunity to do all of that. And having all of those mechanisms available, I think, is the most important thing that an economy and a government can create for their population. So it is an incredible model, what's been created in Australia. We in the United States, we have about 58% of American households own equities, but that means 42% don't. And if you think about that bifurcation of wealth that's being created as a result of that, it's actually something that I think systemically we need to address. And there is something that came out of the Big Beautiful Bill that is actually really, really interesting, which is the America Invest program. Where every newborn starting January 1st in the United States is going to be given a $1,000 investment account that's going to be professionally managed through essentially index funds. And they will not be able to take that money out until they're 18. So they have 18 years of compounding returns. And that will give them a chance then to have income for education, for housing, for things that are important to them as they enter their adult lives. But it gets them engaged in the U.S. economy in a way that it just doesn't happen today. So it is one of the most innovative things that we've seen coming into the financial system in a long time in the United States, and we're very excited about it.
It's quite innovative, although I think Gordon Brown would recognise it as what he introduced in the UK. We had the baby bonds, which was exactly this model that was in place in that administration before the global financial crisis and George Osborne. So I think it'd be fascinated that this is now being picked up by the Trump administration.
But I think it's a little different, I would say, only because it's an equity account instead of a bond account. So you become an owner. You become an owner in these companies, and then what I really like about the program is they're going to have an app that allows them to see not just that they're invested in the S&P 500, but they're going to see all 500 stocks they're invested in.
It was in shares. It was just called a baby bond, but
okay, good.
Choose between bonds,
which is great. I mean that is, I think, such an important creation and it's going to have this long legacy, I think, of engaging the population in a way that's never been engaged before. So the more we can come up with those types of innovative approaches to get the population of every country more engaged in the economy, I think the better off our economy will be.
We have there's a few questions and we've run out of time, so it has to be very quick fire because I think they're good questions. There's a couple of people who are interested in how can governments encourage long-term investing. We've been talking a bit about that. But Adena specifically, Ian MacDonald is interested in and so am I, on the proposal to drop quarterly reporting, because I think certainly people in this room would see both sides of that.
Yeah, I know, and there are two sides to it. So I think we are supportive of the notion of thinking about a different disclosure regime. And we think about it really, is a one-size-fits-all model the best model for every public company in the United States? We have 4,000 listed companies, and is every company really, do investors need that? So I'll give you a prime example, our biotech companies. And we are the market for biotech. We're really proud of that at Nasdaq. But biotech companies can go years without much change in their financial profile as they're developing and going through. And any sort of change in their financial profile would be subject to an 8K. I mean, they have material. If a trial goes well, if a trial goes poorly, they have to report that. But every single quarter, they have to go through this incredible process of putting together the financials, getting them audited, going through the prep for an earnings call, and then communicating with their shareholders, when it's probably nothing much is changing, but it's a huge tax on being that company, where they're still trying to survive until they can generate revenue. And I'm not sure that the quarterly process is really appropriate for a company of that, in that kind of that mode. And we have thousands of companies that are small companies that are just trying to make their way, and they want to give their access, they want to have ownership of every citizen, but they also need to figure out how to earn their way into growth. And I just want to point out, small companies right now are paying on average 40% of their earnings in interest expense. So if they are having to pay 40% of their earnings in interest expense, which, by the way, went way up in the last few years, right, because the interest expense went way up, and that most of them are short-term borrowers and variable rate borrowers. So you've got that going on. Then on top of that, you've got this incredible cost of being a public company. It's a huge tax that makes it so that they're less competitive with their larger peers. And so anything we can do to try to moderate that and think differently, I think is important for us to have that discussion and debate. Right. So we see it as a way. I heard one investor say, great investors don't need the quarterly process. Like, they should be able to understand the overall nature, especially in a long-term orientation, of what is happening in the company. And the 8K process will continue to be required for material public, non-public information.
I'm going to say this next question, which has to be very rapid fire. I'm going to take that as your answer. I'm going to take it as your answer, what you've just said to this question, and the others to get a quick response. Which part of the existing financial markets do you want to change or eliminate if you have a magic wand?
I think we should be growing value, not trading, for the long run. So I agree on the quarterly reporting. We don't need it. We don't want it.
Okay. David, magic wand?
I think a magic wand is going to be tokenization of assets. And what tokenization really enables is going to be an unbelievable increase in terms of the availability of different investment types and access to a lot of different markets. Brazil or Latin America, for example, has very little access to the world capital markets. With tokenization, you're going to be able to have Singaporean investors buying credit card receivables of a Brazilian city. You're going to have all of these with a lot of transparency in a centralized market around the world. So I think that will solve a lot of the liquidity, that will solve a lot of the access, that could provide a lot of transparency, and that might be a big facilitator of flowing or taking capital to areas of the world that does not have access to that type of capital.
Exciting and upbeat ends to the panel. Thank you very much, all three of you.
Thank you.
Please welcome to the stage Shannon O'Neill, Senior Vice President and Director of Studies at the Council on Foreign Relations, Raj Subramaniam, President and CEO of FedEx Corporation, and Peter Voser, Chairman of the Board of Directors of ABB, for a conversation with Bloomberg's Haslinda Ahmed.
Good morning. Global supply chains are intricate and they're exposed to all sorts of disruption. Trade wars, geopolitics, inflation, regulation, and as much as resilience has become a mantra for all companies around the world, nobody really knows what that means, how far we're willing to go and how much we're willing to pay. So, how do we start thinking about resilience in global supply chains? How do we shock-proof, I suppose, global supply chains? Shannon, let's start with you. A macro perspective. Global supply chains have already seen stresses. COVID, the Ukraine war, US-China tensions, and now tariffs. Would you say they're agile or fragile?
Well, that's a great question. And I would actually say, as we look at these last, number of years, and yes, we can point to, disruptions in COVID where, you didn't have goods that you wanted. Really, the story is one of agility. And you saw, the whole world shut down there. And within weeks, sometimes just a few months, everything was back on the shelves. You found a way to move it around. And I would say, again, we are seeing a shock with, the United States putting on all sorts of tariffs, sort of the levels changing, day in and day out as we sort of settle into something. Other governments responding, either some retaliating like China, others responding by going abroad and negotiating other free trade agreements with other countries. So a real changing of these rules. And again, you are seeing an agility, right? You're not seeing huge changes as of yet in supply, right? Things are still, going to various countries. And, my colleagues here, are in the midst of that. They're moving it around those countries. But you're also seeing it, I would say, in pricing and the like, that there's been a lot of agility there. So a lot has not changed, even with, significant both, physical disruptions with COVID and then policy disruptions over these last several months.
Raj, agile. I mean, you moved $2 trillion worth of goods every single year. When you take a look at the supply chains now, how are they different from 5 years ago?
Well, the first thing I would say is that if in 2018 or 19 we had this conference right here, this topic wouldn't have been on the agenda. Nobody really cared about supply chains. And it's gone from there to be a boardroom conversation. Now we're even talking things like tariffs and de minimis. So all the things we do have become very cool for everybody now. I think the world has completely changed. As you saw, a lot of things were taken for granted, on the supply chain side of the equation. And then when there was a disruption, suddenly there's a lot of attention being paid. But I think we've got to trace the origins of trade. And, after the Second World War, trade was 4.5% of global GDP. It peaked around a quarter. And it's kind of been there and thereabouts since then. And FedEx moving 17 million packages a day, we are a referendum on the high-value supply chain. Like you said, we move $2 trillion of commerce. We see the patterns changing quite dramatically now, especially in the last 6 to 12 months. I think we are moving from one set of equilibrium state to another, and we are right in the middle of it. And that's what we are now seeing. The word that Shannon just used, agility, is what's really, really important, both from a physical point of view and a technological point of view. I'll just finish with one point. You used the word resilience, which is exactly the right word. People have talked about, you have to be just in time or just in case. But you have to find the right balance where you're efficient and reliable at the same time, and that's where resilience comes in. And the only way to do this is at the intersection of the physical networks in place and the technological networks that work hand in hand with that.
Peter, I can't help but feel like there's just too much optimism, there's agility, and we're going to be okay. There are still vulnerabilities out there. Where are they?
No, thanks for that, and it's great to be here. Let me piggyback on what we just heard as a first statement. I think this is actually not new over the last 6 to 12 months. As we heard, this started much earlier. I think earlier it was more the consumer which was driving actually to a more sustainable supply chain. And I think many companies have actually reacted to that rather earlier. But it takes a long time to change supply chains. And you have to be careful that you find the right balance, as we just heard, between the costs you have on the inventory, so you keep the products in your hand, versus actually the cost of disruption. And I think it has shifted, that companies across the world, in all industries, are taking much more into account that the disruption effect is much more costlier compared to actually keeping your product more on the inventory side. And if you talk about those type of comparisons, then you're also thinking about where do I actually have my supply chain? Because there you also have a risk of disruption if you are banking on just one factor. And we can come back to that later. Some companies have always done this in a very different way and have the benefit at the moment. But it is quite clear. We have the vulnerabilities we have, that we can talk about rare earth metals, we can talk about the tech sector, the chip sector, etc. And there we have vulnerabilities which are, some of them are more politically driven. We heard the trade, etc., and the tariffs, but others are also because of the evolvement and the evolution of the tech side in the products themselves, which gives us more vulnerability, and therefore we have to think through in a different way how we structure our supply chain.
How are you thinking about resilience in your business? You're in more than 100 countries.
Yeah,
and scale helps for you.
Yeah, absolutely. So we have the scale, which allows us to do more on different things. But we have never actually had a global supply chain at ABB. My predecessors had the vision that we go max for a regional supply chain, or what we do, which is very in favor today, is we produce local for local. So if I take the US, we are 80% plus of what we sell, we produce in the US. It's 85% in China, it's 95% in Europe. So we always had that strategy that we developed the supply chain within the country or within the region. That gave us a lot of resilience during the difficult times like the COVID, but it also helped us actually to design the products for the specific needs of the markets, and therefore also developed then the local supply chains attached to that. So we never went for full efficiency. We had actually a good mixture between reliability, kind of cost of inventory, which we also had to have, and not just optimizing the last cent.
Right. So because of your skill, there's a lot of localization happening. But for a lot of countries and companies, that's not the case. There is a trade-off. Resilience costs money. So how do you think about just in case, just in time? How do you square that, Shannon?
You know, as I think about this, and, you know, as you see sort of geopolitical factors in, I mean, there's a benefit. There's been challenges from diversification if you kind of cross those geopolitical fault lines, especially with the policies that have come down from lots of countries, right? Not just the United States, not just China, but from others. But there's also, and many companies have found this, is that there is also a challenge of geographic concentration, right? And that challenge can be, you know, a natural disaster, which takes out, you know, a particular place you are. We saw that, you know, in the United States with, you know, Hurricane Maria, you know, all kinds of medical equipment was no longer coming from Puerto Rico, so you get that sort of challenge. You have a challenge of geographic concentration if you have a point of failure. We've seen that too in the United States with baby formula, where a plant goes down and all of a sudden we don't import that and we don't have access. So that is one, you know, challenge that I think you face from that concentration. And then there's more sort of amorphous, indirect, which is that you don't necessarily have access to the latest innovations or incremental changes. You don't have access to sort of the networks that you're talking about, the economies of scale and scope. And so I think, you know, as we see some government policies have this ambition to, you know, reshore, bring things all much closer, you know, this idea of, I think, regionalization is sort of the Goldilocks, right? You're not so far away that you know, hit geopolitical fault lines, but you're not so close that you lose the benefits of economies of scale and scope. And I think one thing as we look at the policies that are being laid out is, you know, for any government, even a very wealthy government, it's going to be very hard to subsidize more than maybe a couple industries indefinitely, right? In the end, you're going to have to be commercially viable. And the way you do that is you do need some sort of diversification.
Raj, just in time, just in case, at some point, redundancy is just waste.
Yeah, that's for sure. But I want to talk about this for 1 second here. I think from a FedEx point of view, we are here to serve other people's supply chains. That's our role is slightly different in the sense that we are a referendum on the global supply chains every single day. So the advantage that a company like us has got right now is the fact that we have spent over 52 years now building the networks that's already in place. To the point Shannon was talking about, those networks are very, very critical in that redundancy because as our customers start to change their supply chain patterns, and some of them, for example, we B2C customers move faster than B2B customers, to Peter's point. But when they move, the fact that we are already in those places, because we're already serving those places, is an advantage that companies which have already well-established networks have today. So for example, right here in Asia, in the last few months, literally, we have added flights intra-Asia, for example. We have added flights from Taiwan to Korea. We have added direct flight US to Singapore. We have, you know, different connections from Penang and Thailand. So those things, we just are able to connect it. We can move much faster than manufacturing can move their capacity. So that's the agility and the resilience that we have. The world is going from one equilibrium state, maybe of globalization. I don't think it's deglobalization. I think it's reglobalization. There's a new pattern, the sets that are evolving as we speak. And then finally, I would just say to answer your question, the role of technology becomes extremely critical. At some point, because of the networks and the data and the insights that we have, we've created a digital twin of FedEx that we are able to partner with our customers in a very different way than a supplier-vendor relationship and to then optimize supply chains. We are getting started in the early stages here, but that's going to get increasingly more and more important as we go forward. That's the only way to balance the inefficiency of, you know, more inventory and you know, and diversification. How do you bring it together? Technology is going to have to play a huge part.
When it comes to supply chain, there's a lot of talk about how you need to pull back from your reliance on China. What would be the result of that? Do you see a decoupling of some sort for someone who's operating in China, Peter, in a big way? China's your second largest market. How do you look at that?
given the way we are positioned from a supply chain point of view, a little bit less of a problem for us because we are quite self-standing in China, but we are serving a lot of customers, and we see this actually happening. It is not a complete kind of fact that the companies are leaving China, but they're building their supply chain in a different way. The one thing which is a concern to me is that a lot of companies start to do actually or make the changes into tier one suppliers. But that's actually, if you really want to go for the safety net, for reliable supply chain, which is not just in one country, you need to deal with your entire supply chain. Your tier 2 and tier 3 is as important as your tier 1, because otherwise you are still depending on certain jurisdictions where you don't want to have a dependency. And we see this really happening. I think there are two trends. One is that it's not China plus one. I wouldn't call it this way. I think it is that the supply chains are much more regionalized and localized. So that's kind of one trend. And also through that, the manufacturing, they're actually getting smaller. So instead of building one global manufacturing base, you may actually, customers are building 3 or 4 or 5. Now, one would argue that that's a lot of costs. But given the fact that through automation, through robotization, through the use of technology on AI, etc., the costs actually are coming down. You can run, even in a high labor environment like Europe, you can run now a manufacturing let's say at a competitive level to most countries in the world. So all of these effects are actually at work at this stage. Let me add one thing, because I'm also chair of the largest terminal operator, container terminal operator in the world, PSA International here in Singapore. And what we see is actually the network. There we see some shifts. But those who have an established network, they can react much faster. And we discussed this before. Everybody talks about the final customer, the beneficial cargo owner, and that's the last mile. But what are about the other 10,000 miles, which we are actually covering? That's a slightly different game. And there you can't just have a lorry driving up your in front of your house. You need a structure. You need a network, and you need the digital and the softwares to run this in an efficient way, so that you can actually give the help to your customer to have an optimized supply chain. And we forget that from time to time as we just click and we order. What it actually means to order something over 10,000 miles, that's his job, and that's my job as well. So.
Peter and Raj, taking offense, we will not forget. It's not just about the last mile. You know, we talk about de-risking from China. Can we de-risk from China without decoupling, Shannon? Mm-hmm.
You know, what's interesting to me, and just picking up what Peter was saying, is that, you know, China, you look back 10, 15 years ago, and trade was about, 60, 65% of its GDP. And it has systematically decreased. It's now roughly a third, right? So it has been lowering the amount of trade as part of its GDP. And part of that is bringing in fewer imports, and not just, soybeans and things like that, but intermediate goods, right? Making things within the country. And part of this sort of China plus one or China for China has been that, sort of creating the whole product there and then shipping many things out, as we've seen, and an increasing amount of exports that are going out into the world. So in some ways, they've been de-risking themselves, right? In sort of the reliance. And I think that actually is probably the story of the last, 8+ years, is that, as the world has started talking about the distancing, China's taken this seriously and very systematically and comprehensively. And, the rest of the world has not as much. Lots of talk about it, but less of that. As I look at the model and the policies that are out there, China's moving in this direction, and the United States has an ambition, too, to distance here, and they've been somewhat successful. But some of these policies, if we had a China plus one model, I think we may be headed, at least in some industries, to a US plus one model, right? It will be profitable to produce lots in the United States because it's a very wealthy economy, and the prices will be higher because it'll be protected markets, so there'll be reasons to produce there. But perhaps not producing there for export to other markets, because it will just be, the products will be more costly coming off of the assembly line or the shelf. or some of these other, trade agreements that are being signed around the world, not with the United States, will change some of the, access to markets and the ability to get into those markets. So I think as we look at this, yes, we're seeing distancing, I think in some ways led by China successfully over this last 8+ years. But then, the U.S. policies will sort of double down on that, and we'll get sort of two different hubs for at least some products that are producing for those own local markets.
What are your flows showing?
So I think from what we see is that China to U.S. traffic is down because of, especially as a result of the de minimis going away. However, China intra-Asia flows are up. China-Europe flows are up. China-Latin America flows are up. So, and then the intra-regional numbers is, also now starting to change as well. So this is a much, much more complex question than just China plus one at this point. Like I said, there's a new equilibrium state being formed in these new supply chain patterns, and they're much more regional in nature. And, like we said, the mix of China's exports are now fundamentally shifted away from the United States, primarily in the B2C now, perhaps more in B2B later, and then they're moving into other lanes.
You say more regional, you see a lot more within ASEAN, for instance.
Yes, we do, and that's why, like I said, we have added more capacity, more flights within the region, connecting some of the other, Vietnam and Singapore, connecting to directly to Singapore, United States, for example. So those kind of things are happening as we speak. That's the agility. We can move our capacity far faster than manufacturing can move. So we know from the bottom up, we see these signals and we can react.
Are these disruptions permanent, or are we looking at them lasting through President Trump's term? I mean, we know that when it comes to investing in resilience, it takes a lot of money, right? You get a sense that it is going to be permanent. Peter?
I think disruption doesn't follow election cycles. They follow actually fundamental changes in the markets. So I think these disruptions, they will stay. I think the supply chain is now really being adjusted. It normally brings a lot of investment dollars, and companies cannot just switch that from one day to another. You have got assets in the ground, and therefore you have to actually use them. So I think we are looking at really a changing pattern here, which will stay. And I think for the first time since World War II, we see industrial national policies coming up left, right, and center, and I think they will not go away that fast. There will be multilateral agreements where like-minded countries, as the Prime Minister here also said in Singapore, will work together. But those who have the power and the markets, they will most probably go more the bilateral path. And hence, I think these things will be here for the longer term.
Raj?
Yeah, I think, as I said earlier, the industrial economy is going to take a little longer to change. But once they change, it's difficult to go back. So that's why I mentioned that we are going from one set of equilibrium state to another, and we are right in the middle of this process. Once you get there, you ain't coming back. I mean, so it's going to be there. The other thing is fundamental. I think ultimately the people around the world want to trade and travel, so they're going to figure ways out. And it's not particular one administration or the other. It's ultimately, but the idea of a reglobalized world is probably something that's real.
Industrial policy is not just the US and China, because the US and China are doing it, other countries will follow suit.
Yeah, you're seeing that. And then just to pick up on Raj's point about technology, I mean, as you think about building new factories, and you're not going to build the factories of 20 years ago, right? You're going to build a totally different factory. And we've talked about here, dark factories, and maybe they won't have no lights, but we're going to see a very different element. And that capital investment, the technological investment, there will be opportunities to put in places where you might not have put 20 years ago. And I think that will be part of this disruption. Once you start building those, I think it does not depend on electoral cycles. It really depends on the technological cycles. And if you look at the investment that's happening around the world, particularly in the United States, but all over, right? It is in those technologies. It's in energy and data centers and that future. And that matters for, some of the services that we often talk about, but it's going to matter for this nuts and bolts of factories as well.
All right, let's pause for our poll. The question today is, what's the best way to reduce supply chain risk? What is the best way to reduce supply chain risk? A, stockpiling. B, nearshoring. C, data transparency and security. D, diversification. Sorry, no choices for all of the above, just one of them. Stockpiling, nearshoring, data transparency, security, diversification. Tough choice, I think. In the meantime, perhaps you can talk about, you touched on how technology, data will be important, right?
Yes.
I mean, you use that to anticipate the black swan events. How is it playing out for you?
Well, this is a very critical point here, and I think especially as we, the things are changing, we see the demand pattern changing like we talked about. Operationally, we're on the front lines. We're one of the largest brokers in America, so we have to now, as we move, products from one country to another through the borders. Before people took it for granted, but now it's getting increasingly more complex, and we have to operationally do that. But the other component of this is technology. Just think about it. For every commodity, every country, to every other country, for every commodity, we have the data for classification. We have the data because we needed to have it for doing our jobs. But what we have done is created a data structure and platform, and now it comes with Gen AI to run against these models. So, for example, if somebody is trying to ship something from place A to place B, the number of possible combinations of classification codes you need today are incredible. I mean, before people didn't need it because it was, there was various mechanisms, de minimis, whatnot, to get through that. But today, you don't have that choice. You have to now figure out what is your classification code that's going to get you across the border. So we are now using Gen AI tools to be able to predict that with more and more confidence using the data that we have. So now the data that we have had over the last 40 years, 50 years of operation, that becomes extremely critical, and that's why technology is going to play a significant role. And the other part of it, and I'll just briefly mention it, is that when we talk about supply chain resilience, to be able to create common data platforms with our customers so that we can build the best supply chain solution together versus a supplier-vendor mentality of before.
I just want to refer to the results of the poll. Diversification, 72%. Nearshoring, 24%. Data transparency and security, 4%. Stockpiling, 0%. Interesting, stockpiling. I mean, it wasn't too long ago that people thought stockpiling was the way to go, right, Shannon?
And it may be the way to go in areas of, economic security, right? It may be for basic medicines. It may be for critical minerals. It may be for certain things you do want stockpiles. And we're seeing governments talk about that, adding that. But, right, I mean, I think what this poll shows and what the conversation shows is that when we're thinking about the broad economy, that's not how you're going to do it, right? It has to be a different pattern. I mean, one thing just to add on what you're talking about technology, I mean, one thing that's interesting to me is I watch these free trade agreements signed, and many that the United States just signed with, Asian countries on the recent visit of President Trump is, there's lots written in there about transshipment, about rules of origin, fuzzy, not yet defined, but, if you're going to continue to see these trade in the movement, at least with the United States, there's going to have to be more tracing than there is. And there is, the technology there. The U.S. Customs is investing billions of dollars to have some of that they can scale up, and companies are going to have to do it as well with, FedEx or others.
Well, the complexity is clearly going up, and the days of doing basic algebra is over. You need to do advanced calculus, and that's why we need people like us.
Peter?
We talked about all the costs which are coming in because of the supply chain changes. I think technology is going to be the key which works the other way, which actually takes costs out of the system. Because the transparency of where your products are, how the ship sailing will go, and in our case, in your case, it's the airplanes, etc. There we have now technologies which will save us costs on the one side, but it will also be very, very positive on, for example, for climate change. Because the more we can reduce the sailing time because we have optimized data, the less CO2 actually we will be burning. So there is, I think we need to see this in a very integrated way, that it is not only a cost, it's actually an opportunity, and there is value attached to that if we apply the technology in the right way. And I think that's where, and you use the partnerships with the customer, I think that's where the trust element comes into it. So a company like ABB, but also PSA International, which I also chair, we need to and we will work with our customers, with the liners, in order to optimize actually the supply chain. And through that, we can actually also, therefore, produce incremental value for the ultimate customer, which should also help on the pricing side.
One of the key discussions right now is the supply chain of rare earth, right? Because there is a dominance, China's dominance in the space. How should we start thinking about it? I mean, the thing about rare earths is that it is not rare. It's just producing it gets complicated because it comes with an environmental cost. How do you build that resilience in rare earths? How do you start thinking about a strategy for it when there are few alternatives?
Right. Well, this is sort of that idea of diversification that rose in the poll. I think on areas like this, it's where it's most important. And you've seen, as you say, a concentration in the processing and the refining that has given, if not a monopoly, a real dominance in the market and ability to control price or just access. And, what's interesting to me is just in a few weeks, we have seen, or a few months, we have seen governments begin to react fairly quickly, right? You see the U.S. government investing in and taking stakes in companies that will, process rare earths, create rare earth magnets. You have seen the beginnings of long-term contracts, so you're not dependent on market prices, which when you have a dominant player, you can, drive them up, you can drive them to zero to drive people out of the market. So you're starting to see, and it's not just the US, Europe and others are going there. And this isn't just this administration, right? We saw in the last administration, from the United States side at least, going out and looking for like a critical mineral security partnership, engaging with other countries. And, we've talked a lot about the worries here, but this is a huge opportunity. Because as you say, rare earths are not that rare. And there are a lot of countries out there that want to be involved in sort of technological supply chains. And this is an entree for many that have reserves or could also do some of this next step up in sort of the value.
But it takes a long time.
It does take a long time. But, it is something where you can move. And I think that is the challenge, right? We saw, 10 plus years ago, Japan had a similar challenge with rare earths and access to them. And they started changing their supply chain and are not as dependent. And now it's time for, I think, other countries to do the same.
Peter?
I would like to add here R&D. So it's not just that you optimize your supply chain today. It has a big impact on how you do R&D. I use one example. We are the biggest electric motor producer as ABB. We just brought the first one into the market now where we don't, for magnets, because you need magnets in motors, we don't use rare earth metals anymore. We just do it without. So I think the point which I'm trying to make here is actually that the innovation capabilities, they are now really coming to the forefront. This is triggered now to find different solutions to deal with the dependency on maybe one dominant player. And I think we shouldn't underestimate that one. It will take time, but I think everybody is working on solutions on this one.
Well, I think you answered the rare earths pretty well. I'll just take a broader point here. I mean, the theory of...
You're indirectly impacted by rare earths. So.
Well, no, but theory of comparative advantage was the way things happened for many years. Now, suddenly, a lot of things under the national security umbrella are now being, restrictions on that. So rare earths fall under that bucket. There are many other things. So we need to have a cogent policy around it. We used to talk about, small yard, but, tall walls to make sure that there's a clarity on what those things are. I think we we need to get back to that place where if we're going to do some of these commodities as a restricted, then you need to be clear about what those are. So the rules of the game are clear, then people can work towards that. I think it's when it is in flux is when there's a lot of questions.
As we wrap up, I just want to ask a question to every one of you. What's a key point, whether it's technology, policy, regulation, what's key to securing supply chain resilience? Peter, let's start with you.
I think for me it's technology. I think we use technology in various ways here, but I think the impact of the newest technologies like AI, previously it was digital, but also the way we develop our supply chains and the products. We even redesign products because for local specific requirements, because we cannot produce a certain components within that country. then instead of actually importing it, we just redesign the product. And therefore, technology plays an enormous role in the medium and long term here.
I think robust physical networks, and I've used those very carefully, networks, and that is you can get from one place anywhere in the world to any other place, combined with the technology, combined with an equilibrium set of rules of the game. I think when those three things come together, then we get to a new state of resiliency.
Shannon, the final word.
You know, as I look at all these policies, technology, network, all of those I think are important, but in the end, to create sort of viable and competitive networks, it's going to end up with market forces. So I think that is where companies are going to have to make a decision, what is the right price, and where am I going to place myself? So I think we're going to see some movement, but in the end, I would just say supply chains are rather sticky. And through all of these disruptions, if you have a supplier and a customer that you know and you know well, it's hard to change. So I think we may see less movement than the policies or these other things we're talking about would suggest.
Shannon, Raj, Peter, thank you so much for your time today.
Thank you. Thank you. Thank you very much.
Prime Minister Rishi Sunak's inaugural AI summit kicks off next week. He's trying to position the UK at the forefront of development and regulation of a technology that he said could be paradigm shifting.
Mitigating the risk of extinction from AI should be a global priority, alongside other societal scale risks such as pandemics and nuclear war.
Please welcome to the stage Rishi Sunak, former Prime Minister and Member of Parliament for the United Kingdom, for a conversation with Bloomberg's Parmi Olsen.
All right. Okay, well, thank you. And Rishi, welcome to the Bloomberg New Economy Forum. It's exciting to speak to you. Obviously, you were former Prime Minister of the United Kingdom, but you also have a background in tech. You went to Stanford in California. You've had a deep interest in technology, and you're now an advisor to Anthropic and Microsoft. So a lot to learn from you about this kind of interplay. But let's start with a big question, the 10,000-foot view. Everybody's talking about the global AI race. That's kind of how it's being framed, and winning it, and it being a battle between the US, China, and Europe sort of overseeing, perhaps from a regulatory perspective. What does that even mean to win the AI race? Can you define that?
Yes, well, morning, Parmi, morning, everyone. Great to be here, and delighted to be able to have this conversation with you. Obviously, it's something that you've thought about deeply as well. Now, taking a step back before we talk about the AI race, I think we're living at a time which is both paradoxically the most dangerous of our lifetimes, but also the most transformational. I say dangerous because the old unipolar world order that we were used to is gone. We're not quite sure what's replacing it. Great power competition is back. Technology is obviously a part of that. But also, this is transformational because AI, I genuinely think will be a general purpose technology like electricity, like steam. And these things don't come along that often. And when they do, they have the potential to transform societies, economies. And that's really exciting. So that's where we kind of situate ourselves at this moment. Now, when it comes to the AI race, there is all this focus on the the race to AGI. Who's going to get to the singularity? Is it the US? Is it China? I actually think that's actually the wrong race to focus on.
Okay.
And I actually think the race we should probably pay a little bit more attention to is the race for who can adopt technology and AI in particular the fastest.
Okay.
If you look at the history of general purpose technologies. And actually, there's a professor called Jeffrey Ding who's written about this, and I found his book very powerful. You know, what history tells us is you don't have to be the country that invents the technology to be the one that disproportionately benefits from it. And you think all the way back to the printing press invented in Germany. Actually, it was the UK and the Netherlands which really capitalized on that innovation. And similarly with the second industrial revolution, even though Britain did a lot of the innovating, America did a lot of the commercializing. And I think that's the interesting thing to think about. So that who can sprint to the finish line of getting this AI spread across their economy, across their society in a way that benefits their citizens. You know, a little bit more focus on that race, I think, would be beneficial.
So diffusing the technology to people is part of winning it. And it sort of makes sense when you think about how much money is being spent on building AI infrastructure, that if Europe or the UK capitalizes on that, they don't have to spend that kind of money and just build on top. I want to ask you about your role in AI. When you were Prime Minister, you established the AI Safety Summit, the very first one, in 2023 at Bletchley Park. Since then, there's been a kind of noticeable shift in tone, I think, among governments from let's oversee AI and make sure it's used properly to let's adopt it as quickly as possible. Do you think that's a correct shift, and do you think there's a possibility that actually there could be a price to pay if governments focus so much on just implementing this new and untested technology so quickly?
Well, I don't think the two things are incompatible.
Okay.
And I think it's important to focus on both. Now, we touched on the diffusion point. I think it is important that governments are building what I'd call the diffusion infrastructure. You know, what does it take to get the technology deployed across your country? It's about training people, training small businesses, bringing public opinion along with you, making sure that you and the public sector are actually doing your bit to drive innovation and transform people's lives that way. So I think that is a really important focus for government. Now, look, alongside that, you know, government's first responsibility is to ensure the security and safety of its population, of its citizens. You know, that's the first order of business if you have the privilege of leading a country. And obviously, when a new tool like this comes along, yes, enormous potential for good, but also potential to be misused. And you know, my view was it was important that governments develop the technical capability to evaluate those risks and talk about it with peers. And that was the genesis of the AI security initiative and the summit that I held. And I'm really pleased that has now become a fixture on the international calendar. So South Korea did the next summit, France did the summit earlier this year.
Although the name changed.
Yeah, which I think it's completely fine.
It changed to the AI Action Summit, to the AI Safety.
And I think India's summit this next year will be the AI Impact Summit. And I think that's right. I think the more important thing is that, you know, leaders are coming together every year to focus on AI.
Yeah.
I think having a dedicated event where world leaders have the ability to talk about it
and paying attention to it
is absolutely the main prize here. And now that has been firmly established, as I said. But I think that the important point here is the right thing to do is in my view, not to regulate. And it's developing the technical capability to evaluate risk. And we set up the AI, what is now called the AI Security Institute, which has been rightly mimicked around the world. And I see Gina sitting there, and her and I worked on this together when we were both in government. And I think government's developing that expertise to work with these labs to evaluate the risks, and that does have to involve your national security institutions as well, is the right thing to do.
Yeah. And it's fortunate that the tech companies who are building AI models like OpenAI and Anthropic and Google are working with the AI Security Institute to voluntarily give them access to their models. But what happens if those companies decide they don't want to give that access? And for example, Mark Zuckerberg, who is making open source models with Llama, recently has been saying, actually, we'll probably go more closed source as our models become more capable, as they get closer to that threshold of building machines that are smarter than humans. doesn't that mean that maybe the AI Security Institute won't get that access it needs to test those models? What do we do then if they become more opaque?
Yeah, well, so far we haven't reached that point, which I think is positive. And what I've seen for the most part is, companies committed to, what they would call responsible scaling practices and working really well with our institute in the UK, the institute in the US and others to do what's called pre-deployment testing. So before the models are released, to go through that red teaming and those exercises. And I think actually what those companies have found is they benefit from that interaction because ultimately they don't have the same national security expertise that exists within governments. So having those people be involved in the process of...
Just the collaboration.
Exactly. That collaboration is valuable to the companies. And look, I don't think anyone wants to put something out there into the world which they think could genuinely cause significant harm, whether it's cyber, biological, or nuclear or chemical
They don't
nature.
intend to put
Exactly. So if we have the ability to, look, let's work through those things with you in a collaborative fashion, and this is not regulation, this is, as I said, technical evaluation.
But just to make sure that there are no unintended consequences with algorithms that are perhaps designed for engagement, the same way social media put out technology meant to connect us, but it did end up having these harmful consequences.
And that's exactly the point. And look, these companies all themselves conduct this testing as they should. But I said I don't think you can, as a government, just say this has got nothing to do with us. Of course, you need to be able to make those evaluations yourself and add something to what the companies themselves are doing. And so far, that has been, I think, a mutually beneficial and positive collaboration. Certainly in the UK, we found those conversations with the companies have been positive, productive, and they are committed to continuing to engage, and long may that continue.
I was going to say long may that continue, because that is a great place for things to be right now, and let's hope that that continues to be the case. Let's just talk about something a bit broader, which perhaps a lot of members of our audience can relate to, and that's the job market, and particularly preparing our children for that job market. I have a 15-year-old, you have a 13 and 14-year-old. We were talking about being parents of teenagers backstage and what that entails. With so many university graduates now struggling to get jobs because companies are using AI for intern-style roles, how do you prepare your own kids for that? Well, what kind of skills do you think are most important for them?
Yeah, so I have two kind of young teenage girls, so they'd much rather talk about skincare products than they would talk about, preparing for the job market. But no, I mean the way I've thought about it a little bit, and this is actually informed as well by looking at the work that Stanford economists are doing, where I spend some time, and also looking at the data on LinkedIn, which I think is a fascinating insight into what's happening in the job market.
So you're just looking at LinkedIn yourself, just looking for those trends
and seeing what's happening. And what you take away from that, what I take away from that, what I tell my girls is that first and foremost, of course, you just need to be familiar with how to use these tools.
Yeah.
I think everyone accepts that.
Yeah.
You see jobs requiring some degree of AI literacy are doubling year on year in the UK and the US. I think that will continue, and that's not software experts or computer scientists. That's just whatever job you're doing, having the AI literacy skills so that you don't lose your job to someone who is proficient with them, I think is critical. So I think that's a kind of overriding piece of advice. I think the few specific things I think about is that we're never going to lose the importance of being able to think, to reason, to question critically. So I think those skills will be incredibly important for our young people to develop. And similarly, those human skills. Actually, if you look at the LinkedIn top-ranked skills, only one or two of them relate to AI. The rest of them are all things that talk to human interaction, interpersonal dynamics, empathy. And so I'd make sure that my girls were making sure that they spend time developing those skills as they grow up. And then I think the last thing, which is going to be a real change actually, is everyone, whether you're a new graduate or a senior leader, is going to have to get used to managing a team of agents. I think that will be the age of agents will come relatively quickly, and it's great. We're used to learning how to manage teams of people, but I think actually very young graduates will soon have to learn how to manage a team of agents and understand what that means, how to divide up tasks, how to make sure that the work being done is right. And that will be a new skill. And I think that, the nature of work is going to change in that regard. And, my kids, your kids are going to grow up into that world. And I'm excited for them. But it will require, I think, a mindset to just keep learning and keep curious.
Being able to adapt.
To adapt.
Yeah. Well, Rishi, honestly, I have so many more questions I could ask you, but we are unfortunately out of time. So we are going to be bringing on our panelists shortly. But for now, thank you very much, Rishi, for that wonderful conversation.
Thank you.
Please welcome to the stage Mohamed Kande, Global Chairman of PwC, and Forrest Li, Founder and CEO of C Limited.
Well, welcome to our panelists for this next segment. This is on AI's report card. In 10 days, it's going to be ChatGPT's 3rd birthday. So who would have known 3 years ago that this little text box would turn into an AI boom that would lead companies to spend trillions of dollars? But here we are, and it really shows we don't know what's coming. When things happen, they can take us by surprise. So I'd love to speak to our panel now about how it's all gone so far. And I'd love to start with Mohamed, who's the chairman of PricewaterhouseCoopers. We know the AI adoption has been so fast for consumers. ChatGPT is used by 800 million people a week, but it's been slow for businesses. Now, part of your work is helping businesses implement it, and you're also using AI a lot yourself at PwC. So what are the wins and what are the struggles for you guys?
Very interesting question. I would tell you that when it comes to the wins, I think we are past the stage where companies, including ourselves, are asking whether they should adopt artificial intelligence or not. That is no longer the question.
Right.
The question is now, how fast can we go? So some of the wins that we have seen were, companies using AI to become more productive or more efficient. We did it to ourselves with the different people, the people that we have across the world. And this has been a success. The first thing that we had to do is to make sure that people didn't fear artificial intelligence for the jobs. Because it's one thing to use artificial intelligence in your personal life. On the job, there were some threats around job replacement for artificial intelligence.
Yeah.
So some of the wins that we have noticed are companies using artificial intelligence and making sure that they have the people embracing artificial intelligence. I mean, one of the first decisions that I had to make was to decide, how do I make our people learn about artificial intelligence on the job? We gave access to all of them in all 139 countries where we operate. And I had to ask my question, what do I do in the US? What do I do in Europe, in Asia? And that was the wrong question. I said, give it to all of them.
Just give it to everybody.
Just give it to everybody and let them play with it. And we saw a lot of the productivity improvement coming directly from our employees. And as you and I discussed, we even told them, do not think that artificial intelligence is a threat to your job. Consider artificial intelligence as a digital colleague. It flips the mindset of the people for adoption.
Yeah.
So there are some of the wins that we have seen. Some of the struggles was around, how do you measure the return on investment?
Oh, yes.
Because you see the adoption on the productivity side, but in many companies, including us, this has not led to letting people go, or attrition, or replacement. It was more augmentation. That's what we have seen. And augmentation sometimes is hard to measure because it's the thing that you choose not to do rather than the thing that you stop doing.
Right.
Yeah.
Right.
So that's what we saw. And now we are seeing the aim for artificial intelligence. Things are moving into how do companies use artificial intelligence to change what they do, to do things differently, or even do things that they never did before. So that's where the struggles are today, but I would tell you that we're in a very different place. You save almost 3 years for ChatGPT. We are in a very different place about asking our question whether we should use it or not now.
Yeah.
How fast do we go?
It's a no-brainer.
It's a no-brainer now. By the way, it's not that the future is coming. It is already here.
Yeah. Well, you're building it, potentially.
Yeah, exactly. So,
Forrest, you run and have founded C Limited, which is essentially the Amazon of Southeast Asia. That's how some people refer to it. It's the e-commerce giant, among other software and online services that you provide. Asia has seen a huge adoption of AI. How is your company using it, and what's worked and what hasn't worked so well?
Well, I mean, like as a technology company, we are super excited about what we have seen in terms of the AI advancement and the development. And we would admire what has been developed in Silicon Valley and the rest of part of the world in terms of the fundamental technology breakthrough. But as a technology company, specifically working focus on the individuals, consumers, and especially working on emerging markets, specifically in Southeast Asia and Latin America, we are more excited about what that means to people's daily life. So, and we have seen a lot of impact, right? And I would describe the AI is a kind of very powerful production tool at this moment. And I think for us, we are all grow up, we are familiar with the PC, with the laptop, and probably more recently the smartphones. Just imagine how much less you can do on a daily basis without access of a PC and without access of your phone, right? And I mean, I think that is a way I think about definitely the new tool, the new powerful tool as AI will just make everybody's life, daily life, more productive and probably more enjoyable. So that's because of the PC, because of the laptop, my life is much more productive and enjoyable. Specifically in e-commerce, I think I love to give audience a bit sense about what we have seen is really working. And we are not only serving hundreds of millions of consumers, because we are also serving tens of millions of sellers, right? They are could be individual, could be the small, medium-sized businesses, right? They're all entrepreneurs. And they are selling things through our e-commerce platform, Shopee. And the things, a small example could be even I'm a good seller, I can get my merchandise in a more cost affordable, right? And but I don't know how to introduce. I'm never really educated how to write a product description.
Yeah.
And how to take a nice photo, because that is require very specific skills, and how to shoot a nice video. And end up, I may need to hire an agency and hire somebody to do the work. And the quality may not be always there, and also depends on how much I can afford. It depends on what I sell, what is my margin. And now, we just, from the platform perspective, we just provide those AI tools to millions of sellers, right? And
wow.
They can easily just use our tools and put just a picture whatever you have, and the AI tools will kind of generate just do a touch up, just make become a much nicer photo.
Mm-hmm.
And what AI even can do is that they just combine several photos into a quick video, and it's very useful when buyers look at it now, I don't know. I never read a text manual about how to use a product. I always just go to the YouTube, search, how to use these things. I just watch a 1-minute video and I get it, right? And I think that is a kind of the similar experience on e-commerce platform. And people kind of doesn't want to read a product description or just look at photos. A quick video that helps.
And Forrest, can I just ask, since you've implemented that, have you noticed any? I know it's early days, but have you noticed any difference in sort of your revenues or the number of products being put up on the site? Has that feature actually helped the business in some way?
Yes, we provide this kind of for free to all the sellers, because we think that in generally benefit everybody, both the sellers and the buyers. The buyers also love to see nice photos, right? And nice content. And clearly we see the adoption is very high.
Adoption
which means
has increased.
As a seller, because
yeah.
they can choose use or they can choose not use, right? And the take rate is very high. And on the buyer side, and we realize the engagement level is going up and the conversion rate is going up. They stay longer time with the product. They want to know more, and it's quite an enjoyable experience to watch a video. And and also there's more conversion, right? And in terms of the placing an order. And another part from the buyer perspective is usually people love to read reviews. There could be, for one product, one seller, people care how other people think about that. It could be hundreds of reviews, and it's take time to read all of them. And you have to process, okay, which make more sense, which is more relevant.
Which one do I trust?
Yes, and now there's a kind of a quick AI summary.
Yeah.
Okay, so this is, in general, how many people think about this is a good seller, this is a good product. And then if you really want to dig into details, you can still read the review, but the AI summary can give you a quick kind of sense about the sellers and the product.
That's such a great kind of rundown of how that's working for you, because I think one thing on the minds of so many businesses is return on investment for AI, because it is expensive. Of course, it's expensive for the companies to develop. And as you, Mohamed, mentioned, you can see that there's productivity, but that's perhaps a little bit difficult to measure. In Forrest's case, that seems very clear. You've got very clear metrics that you can measure. Government, how on earth do you even measure the return on investment on AI?
Listening to Forrest's absolutely brilliant example of how he's using it is a good reminder to me and people in government. Our primary job actually is just to create an environment where people like Forrest can go and innovate and do what they do. And so that's when our conversation earlier about regulation, why I've always been in the camp of saying that we must be pro-innovation when it comes to this new technology. We're in the very early days of it. What we don't want to do is do anything that will stifle Forrest's and entrepreneurs like his ability to try new things, to generate value for their customers. So I think that was a great reminder on that. On government, the most easy thing to do is look, how can we automate all the government services that every one of you has to interact with on a weekly basis, daily basis, to just make that both cheaper and more efficient, which particularly for constrained European economies is of paramount importance right now, to find some savings in government spending. But how can we just make people's lives easier? And Forrest also mentioned that from a commercial perspective, but government should set itself the same bar. Is how do we just make those interactions with government easier and make people's lives better? And to give you one practical example, one of the initiatives I'm particularly passionate about is helping introduce a targeted screening program for prostate cancer in the UK. Now, prostate cancer has become the most common cancer of men in the UK. 1 in 8 men will be diagnosed with it, and I've been advocating for a targeted screening program, national screening program, because prostate cancer, if you identify it early, we're very good at treating you and keeping you alive. And the problem is it's symptomless. So if you miss it and you only pick it up later, then your chances of survival drop quite precipitously. Now, obviously introducing a targeted screening program countrywide basis is quite an expensive and costly undertaking. However, AI has changed the dynamics on that, because now AI can read all those MRI scans that are part of the diagnostic pathway.
And sorry, by the way, you mean generative AI, the latest tool, not the classical machine learning stuff. This is a new opportunity.
Which has meant that whereas before you think, well, look, do we have enough radiologists? Can the system handle all of this? Now it's very clear, yes, it can, because these new tools are incredibly accurate and quick at assisting our clinicians at going through the MRI scans, which now makes it much more easy to say, look, we should introduce this targeted screening program. We can afford it. We can handle it from a capacity perspective, and in the process then save lots of people's lives and keep people's loved ones alive. Now that, those are kind of the practical examples where people can see, okay, this is making a difference to me, and this is, the government, the state has helped make that a reality. So I think trying to find those examples is really, really important, beyond just saving money.
So the return on investment can be saving actual human life for governments. So the title of this panel was the AI report card. So I'm going to ask you all a quick fire question. I'm going to start with you, Mohamed. Since you were one of the first power users of generative AI at PwC, what kind of grade would you give generative AI in terms of how useful it is today, with A being the best and F being it's a total flop?
I give it an A.
Okay. And why is that?
And I would tell you why I give it an A. It's not because of what we see today, but what might come. Because I truly believe that artificial intelligence is going to create a new age of innovation. There is so much capital being invested. The example that you just gave, you are innovating how you're running your business. You're talking about innovating around screening for diseases, etc. What's coming next? So when I look at the potential today of artificial intelligence, not just generative intelligence, you have industrial AI, artificial intelligence coming in, and all of the things that are currently in development, and the amount of capital that are being deployed. Mm-hmm. We are only witnessing the beginning of a new innovation age. I truly believe that. And the last time we saw that was 25 years ago.
And the amount of capital going in is a reason you're optimistic? The fact that so much is being spent?
And the speed of development that we are seeing, the way the models are improving really, really fast, looking at all the use cases or the agents that are being developed, Rishi and Forrest gave some examples of how it's being used. Every day we are seeing new examples, not based on what is being provided. The large language models, yes, I know a lot of innovation, the new chipsets are even more powerful than before. But Rishi, I would tell you, I totally agree with you. The supply side of AI, providing AI is a great thing. We need it. The adoption side of AI is what's going to create the future. The diffusion that you talk about.
Diffusion.
The diffusion is important because that's when you create new business models, new companies, new ways of solving problems. And that is why I give it an A. Not because of doing what we do today more efficiently, but about the things that we will be able to do that we cannot do today.
Okay, so Mohamed, Forrest, Mohamed's grade is based on the future. You can do that too, or you could give it a grade today. So please, what would you say?
Well, I would say I will give 7, and in the context is I'm truly excited and I'm very convinced, and AI will be great development and will create a lot of values and will change people's daily life in many aspects, and in general I think make people's life better. But I think the reason I give a little bit lower score than Mohamed is. I feel we are still at very, very early stage.
Yeah.
So we shouldn't be too satisfied what we have seen and compared to what we're going to see in the next 3 years, 5 years, or 10 years. I think 10 years later, when we truly appreciate and what AI can do and can change the society, change the community, change the life, whatever we have done today, it's very, very small. It's kind of like so it's still, I think the reality will beyond today what we can imagine. So that is my take, and specifically I think there will be many kind of aspect, right, and there will be change. But today in our organization we just completely embrace the AI. So we from our employees, they ask us what is our company's kind of a view and standpoint. Can we use all the AI tools, and what is the consideration in terms of the safety and the confidential concern, all those things. And in general, our approach is we just embrace it, and you do, and we try to figure out all those things by working closely with all the big giant like Google or OpenAI, right? To embrace to adopt their models, and at the same time we figure out all those issues bear in people's mind. But in general, we say do it, and if something didn't work out, and we'll fix it. And at the same time, in company, we also developed our own kind of the agent platform. So we provide the tools, the productivity tools for all the employees, and then even our operational team without any coding experience, and they can develop their own agent and to do this to their day-to-day work, solve their pain point. I can give a quick example. I think everybody can appreciate, right? And we handle millions of parcels every day, and in the e-commerce business, and we always get concerns the people say, I didn't receive my parcel, or how come it's supposed to be here, but I didn't. Every time we get those customer complaint, we have to investigate it, and is it delivered the wrong places, or maybe the delivery driver steal it, or the customer just kind of give us a false report. There's so much work. And if it's an individual case, you make several phone calls, it's handled. But if you think about it, it's millions of on that scale and the total scale, and even just 1% is 2%. That is a lot of work. And our Malaysia local team, logistics team, and using our in-house agent platform to develop an agent. So basically, every time, like when the delivery man delivered a parcel to the customer's home, the delivery man will need to take a photo as a proof, and then upload. Before they also upload to our database, but now they upload, and the agent can immediately give the feedback to the photo. Oh, it's not clear enough, or like it is not as a good proof. Oh, you should make the address, and it's clearly show this is apartment or this is just a house, right? And give the, so this is a resolve, a lot of pre-resolve, a lot of a dispute, and people say, okay, I submit the photo as a proof, but the customer said I didn't receive it.
It's like a whole other workforce that you've got doing that for you.
Yes, and it's pretty much pretty much real time. So that's solve a lot of a problem. And I think we have many tools again. So this is the tool empower people without any coding experience, and they can develop such a software tool. Yeah, and like relatively quickly, and put into daily use is solve the practical issues they have today.
That's a nice example. Rishi, what's your view on
grade to give it? Yeah, I tend to agree with Forrest, but listening to him, you think, isn't that an extraordinary use case already for a technology that, as you said, is barely a couple of years old? Mm-hmm. And I think that's the exciting thing. That's why Mohamed is giving it an A grade today, is because the pace that it is improving at is really quite striking.
Yeah.
And that was the thing that I found in the job. And it's tricky for policymakers or any of us to kind of understand exponential growth in general. But the speed at which these models are improving themselves, and then you kind of think through what that will mean in a few years' time.
What grade would you give it?
I'd probably where Forrest is.
B, C?
Yeah, exactly. What did you do?
Okay.
7? You did a 7 or a B?
You're the optimist.
But I would say, though, that I totally agree with the two comments. But
we are very early. Right, this is the point.
Exactly.
We are in the foothills of this, and it is improving so quickly that you can feel very optimistic about where we're headed.
Well, Mohamed made this point, a very important point about capital and how much is being spent. And for you, it's a sign of a reason to be optimistic, the fact that so much is being spent, presumably because in the past, when a lot was spent, then it led to good things. But this is unprecedented, trillions of dollars being earmarked for data centers and chips and other forms of infrastructure. And what I think is really paradoxical for a lot of us, and probably for you as well, is it's not really within our control. We will be affected by it, but these decisions and this money is largely being spent by a handful of very, very large companies. Mm-hmm. And some would look at that and say, that's a real consolidation of power happening economically in terms of influence and of impact. If something goes wrong, or if someone with a crazy radical agenda becomes in control, we might pay a price for that. And I just wonder, how problematic is that concentration of power that we're seeing in AI? Or is that status quo actually, it's worked out fine and it should continue? And I put that to the panel.
This is a great question, because we think about, there's only a few companies that have the capital to do this.
Right.
It costs a lot of money. And in artificial intelligence, as we all know, it's not just the development of the models. Build out of the data centers that you mentioned, buying chips, cooling equipment, industrial equipment, real estate, it costs a lot of money. You don't have enough companies in the world that have the balance sheet to do that, or the capital to do it. And by the way, you cited a couple of other things like the printing press, now the industrial revolution and all this. It was not that many companies that built it, because it's too much capital. So when you look at the signals of today, they're the same that we saw before. We call it this intelligence age with artificial intelligence, but the same fact pattern happened before. So that concentration is okay on the supply side.
Okay.
Now, on the demand side, on the diffusion side or adoption side, that's where you will have creation of new business models. New companies are going to come in. People will change how they do drug development, how Forrest is running his business today. You might actually build some new business lines because of artificial intelligence. So it's okay to have concentration of power on the supply side, because it will create innovation on the demand side. That is why I don't worry about this, as long as they keep spending. And you point around spending. You know, a lot of questions were being asked to us around what's going to happen next? How do we measure return on investment and EBITDA and all these things? We were trained for the past 15 years to have the answers. You know, if you were doing the following things, what will happen next.
Yeah.
The world is changing. It's uncertain. Nobody can predict the future. So what do you do then? You look at leading indicators because you don't have the lagging indicators. And the leading indicators are speed of innovation, capital being invested, number of use cases that people are trying. And if all of these things happening, something good is coming on the other end, including innovation for companies like Forest is running today. That is why I'm so optimistic. But I will tell you, I don't fear the concentration. I'm actually glad that they're spending the money because we are all going to benefit from it.
On that point, and feel free to talk on this, the other question, but people have talked about an AI bubble. It sounds from all of you like that's not a huge concern because this is all being steered in the right direction. Or am I wrong in saying that?
Forrest, you go first.
Well, I mean, I think it's like how do you define AI bubble, right? And I think it's like considering what value potentially could be created. I think it's totally fine because, like as you mentioned, and now the key drivers of this AI new technology revolution is by several big giant companies in the world, technology giant companies, and they are all the commercial companies and they all calculate the return, right? And they are all very savvy and very disciplined in terms of every single dollar to invest because they are like I have a lot of interaction with them. They have been all in the public, like most of them in the public company for many, many years, right? Yeah. And they have built up this discipline and the capability and how to deploy capital, how to do the capital allocation efficiently. I think if they believe, okay, so as you mentioned, it's like hundreds of billions of the dollars put into this new technology development on the annual basis, and the return is huge. And I think like from the talk about a bubble perspective, then it's about like what time horizon you look at. And you think now it's like things is short of the data center, a lot of investment go to the data center, go to the hardware, then it's go to the electricity, go to like the power, the water. It may be like in the short period of time, is it perfectly paced with the technology development and the transfer to the real value of people's daily life? Maybe there's a ahead, then there's a behind, right? And but in the short term, there's always this adjustment, a line need to happen. And but in the longer term, right? I think all those infrastructure we build today will eventually benefit and the whole human society, and the technology never disappoint human being in history, right? And we always believe technology advancement is the single biggest value creator in human history. And from that perspective, I think there's no bubble. But that doesn't mean
no bubble.
From a very long-term perspective, but doesn't mean okay. So you buy an AI-related stock and tomorrow you're making money. So that I'm not commenting on from the capital market perspective, but from the technology, eventually the value creation. I think that's fine.
I think there's an interesting thing that Forrest just said there, which is about historically we've always benefited from new technologies, and it has worked out and created a lot of positive impact for society. The interesting thing, if you look at it today, is amongst Western countries, and there's an Anglosphere in particular, there is actually an enormous amount of fear and skepticism about AI.
There's a lot of fear,
and that is interesting, and it's different in two respects. It's different to what you're seeing in countries like China, or India, or the Gulf, or here in Asia more generally, where people have just a different view about it. They're more positive about it, impacting their lives. They feel good about using it. You are not seeing that in the West in the same way. And secondly, it's different to the past, because if you look at the last digital revolution, you didn't see that. And so when we had the previous digital revolutions, people even in the US and the UK were very positive about the technology, and they are not in the same way today. They are more fearful. And I think that is a challenge.
And also, but companies who are driving this fear missing out. So that's just another type of fear in a way that's also driving the growth.
And that's where you're getting the investment from. So I think in order in order to make sure we get all the benefits that we're all talking about, I think it's incumbent on actually everybody. It comes from political leadership, but also from industry, to be able to bring their populations in these countries with them.
Yeah.
Because actually, that to me is the thing that I look at, and I think it's all great, and we can sit here and talk about all these wonderful things. But you've got huge swathes of your population that are skeptical or nervous. We need to overcome that.
Yeah.
And I think that is something that I think a little bit about. And jobs are obviously a part of that, but it goes more broadly than that. And this is happening very quickly. And I think, Mohamed, you touched on this at the beginning. And you look back at these technological revolutions. It took, when you look at how long it took 100 million people to use the technology, I think it took something like 50 odd years for 100 million people to use electricity or to have electricity. And you fast forward to the PC, I think it took something like 15 years.
Yeah.
And then the internet was 7 years, right? ChatGPT was 2 months, right? Like that is the speed that this is happening around the world is quite unprecedented, which is exciting, but it does mean that, as I said, we have to work harder and quicker to bring people along with us.
One final question. Does anyone want to just answer something that address what Rishi said about the fear that people have? And how would you address overcoming that fear that people have of AI? Is it about just showing them how it works, or is it a policy move, or is it a cultural thing?
I would say transparency, governance, and also
a
set of regulations that are being developed by people that actually understand artificial intelligence.
Yeah. Great answer. Okay, so very optimistic panel here on AI, but also with some concrete points about how things need to improve. So thank you so much to our panel, and thank you very much to our audience for listening.
Thanks very much.
Thank you.
Thank you. All right. Very good.
Please welcome to the stage His Excellency Ashwini Vaishnav, Union Minister for Railways, Information and Broadcasting, and Electronics and Information Technology for the Republic of India, for a conversation with Bloomberg's Eric Schatzker.
Good morning.
Good morning, everyone. Minister, it's such a pleasure to have you here.
Hi.
Welcome to the New Economy Forum.
Thank you.
Which, of course, I'll remind everyone is going to India next year. And one further reminder, the QR code, please submit questions. Minister, here's where I'd like to begin. The global technology landscape is rapidly bifurcating into two competing regimes. Right? On the one hand, you have a US-led Western regime, and on the other, you have a Chinese-led Eastern regime. Each of those regimes has its own semiconductors, its own supply chains, its own compute infrastructure, its own AI models, its own social media, data governance, regulation. Where in this bipolar order does India fit?
I don't think it's bipolar. It's more like T3. Three technology countries which will dominate the future. India will be part of that T3.
The United States, China, and India. Okay. India has a ways to go before it can compete in all of those arenas. with the United States and China? What's the strategy?
Our design capabilities, our ability to look at very complex problems and solve them, our ability to have a talent pool which can be basically deployed in any major technological stuff. These are certain advantages which we think will hold us very strong going forward. I'll give you certain examples. I'll give you a few examples too. First is, let's take the case of semiconductors. Now, we started on the semiconductor journey just about 3 years back, 3.5 years back. Today, we already have an ecosystem developing just in 3.5 years, where production of chips is starting, design of some of the most complex chips is now happening in India, all the way up to 2 nanometers. I'll give you a second example. Take the case of space. Now, we opened up this sector just a few years ago, just about 4.5, 5 years ago. Within a short time frame, we have about 80 startups working in space technologies. I'll give you one more example. Just about 10 years ago, India had just about 400, 500 startups. Today, we have 190,000 startups. We are among the top 3 startup ecosystems in the entire world. The entrepreneurial energy, which is one of the foundations of our civilization, was kind of throttled because of the policies since 1950. Those have been released by our Prime Minister Narendra Modi ji. In the last decade, so much simplification has happened, so many of those constraints have been removed, that the entrepreneurial energy is coming forward. And that's what drives technology, that's what drives innovation. That's what gives me the confidence that the world will have a T3 configuration in which these 3 countries, India, China, and US, will be leading most of the technologies.
How long will it take for India to be competitive on all of those different levels with those other 2 countries, the United States and China?
Different technologies and different streams will have, of course, different time frames.
Trajectories. Yes.
I can say in case of semiconductors by 2031, 2032, in that time frame we'll be equivalent to what many of these countries are at today, and then it will be a race which will be a very fair and a level playing field. Similar things will happen in other technologies also.
Minister, conditions matter.
Yes.
Has the widening divide, or maybe deepening competition, another way of looking at it, between the United States and China, changed the calculus for India's ambitions, its opportunity in technology?
Our Prime Minister has always told us that we should strengthen our line, we should make our line longer, we should make ourselves more stronger, we should make sure that our capabilities increase rather than trying to reduce somebody else's capabilities. We don't think in...
You don't think in zero-sum terms?
Yeah, we think that we have made lots of contributions to the human society over last 5,000 years, and we as a civilization will continue to make those contributions. We should be able to strengthen our capabilities, further our capabilities going forward.
Most countries are forced to make a choice. Am I going to align myself with the United States? Am I going to align myself with China? For India, is there such a thing as digital non-alignment, digital sovereignty, if you like?
Digital sovereignty is a point that practically every country today thinks about.
Would like to have the luxury to think about?
More like ability to have control over your own future.
Yes.
In that sense. In a digital world, there are no boundaries, as we know. Internet doesn't follow the global geographic boundaries. Digital sovereignty is definitely important, but our policy has been, our foreign policy, as well as our technology policies of multi-alignment. Our policy has been that how do we contribute to the growth of technology and betterment of entire humanity through our contributions. That's the way we think.
In a world of, let's call it, weaponized supply chains, and that is the reality today. Where, at the moment, I'm not talking about 2031, but where at the moment does neutrality end and alignment begin? Where do you need to work with at least one of those two other regimes, whether it's semiconductors, artificial intelligence, 5G wireless, or the next 6G wireless, critical minerals? How do you think about that?
Today's supply chains are, I don't think they are in 0-1 state, right? Multiple players are there, multiple geographies, a small component, a chip which gets manufactured, that passes through so many boundaries by the time it gets its final finished shape. So we have to work with so many different countries and so many different partners, and that's where the factor of trust comes in. We believe that India is a trusted geography, it's a trusted country, because we believe in IP rights, we very strongly protect IP, we believe in developing or rather co-developing solutions. I'll give you one example. End-to-end telecom stack for 4G and 5G. There were just about two companies from China, one from Samsung and two from Europe. Now we are the next country where we have developed the complete 4G and 5G telecom stack. And
with your own proprietary technology.
With our own proprietary technology, and we have given a level of sophistication which is better than the existing products. And that's possible only when we work with so many different partners. That's not possible working alone. You have to work with partners. That's the way technology works in my understanding.
Minister, I'd like to ask you about social media. As the minister, this minister, as you can see, has a very large portfolio. As the minister, both for information and broadcasting and also electronics and information technology, you are at the nexus, aren't you, of one of the most important debates in global governance, how to regulate social media.
Yeah.
You have two competing forces. You have the need for a harmonious and governable society, and you have the need for the freedom of expression. How do you balance the two? How do you keep algorithms from poisoning democracy?
It's indeed a very big challenge that all of us are facing. My interactions with practically every minister, whether it's from tough kind of governments to a very liberal kind of government, everybody is worried about the very significant influence that social media is having on the trust between institutions and the citizens. That trust is getting absolutely broken because of deep fakes, because of synthetic material which is flowing around, because of rumors which get amplified at the speed of light. So all those things are really, really worrying everybody. And in my opinion, I'm not saying that's the policy of Government of India. In my opinion, social media platforms must start taking responsibility of what they are publishing so that the society at large doesn't get harmed by what they publish.
They're not doing that of their own free will. That's obvious. So what approach does India take? Does it take a more rules-based approach like Brussels? Does it take a more free market approach like the United States? Or does it take a more state-directed approach like China?
So we take the approach called techno-legal approach. Such technical problems cannot be solved by simply legislating something. Such technical problems cannot be solved by mandating something. We have to have a combination of technology as well as legal structures where we can govern. And I'll give you one example. Our Data Protection Act, for example. Unlike Europe, we decided to go for a principles-based law. Now, we have defined the principles. We know that technology evolves every quarter, sometimes every month. So under such circumstances, you cannot have a very prescriptive kind of law which scuttles innovation. We believe in a combination of innovation and regulation where our bias is more towards innovation. Our tilt is more towards innovation. So that the good things can come to the society while the harm can be separate. And it's a difficult thing, but we are very deeply engaged with the industry as well as civil society for getting this right balance.
The government has been, at times, willing to issue takedown orders and demands for content moderation, excuse me. It makes me wonder, in your experience, do you paint all of these social media platforms with the same brush? Are they all equally challenging? Or would you differentiate between, say, YouTube, extremely popular in India, Facebook, also extremely popular, Instagram, Snapchat, X? Is there a differentiation between them? Would you call any of them out as being easier to work with and others as being harder to work with?
See, the point is very simple. Every company which works in India must follow India's constitution, must follow India's laws. It's a rule of law which has to be followed by everybody.
But do they follow the law?
They have to follow. Otherwise, how will they function? Yes,
well, if they all follow the law, there'd be no need for regulation, would there? And enforcement.
There are challenges, of course. And as you rightly said, some of the platforms have much larger reach compared to some other platforms. Our request, and in fact we have been discussing this with the platforms even at the topmost levels, every platform must understand what is the social structure of the country in which they are operating. The society of US is not the same as society of India. There are differences. How does a platform react to the circumstances? How does it operate in the scenario, the diversity that we have in our country? That must be respected. That must be followed. That must be taken into account when they make their community guidelines, they make their policies, and they operate. That is something that social media platforms must understand to be successful. Otherwise, there will be stronger regulations. That has to be. Otherwise, society will be disturbed.
Let's return, if we may, to semiconductors. The economics of fabs are daunting. We're talking about tens of billions of dollars in capex investment for each facility. Does India have the financial resources to match the subsidy levels that other countries are offering to entice fab development?
So that was the question people asked me when we started the semiconductor mission in 22. There was a lot of skepticism at that point of time. But today we have 10 units which are under construction. 3 of the units have started pilot production. Actually, 3 will start commercial production going forward in the first quarter of next year. The progress is very, very fast. Second, the talent that we have, the talent pool that we have, and the way we are deepening and widening that talent pool, that's something which no other country can match. We have 298 universities in which world's latest semiconductor design tools are available to the students for free. And students, far-flung universities, students are designing chips. We have a facility where they are able to tape it out and test it and validate the chip. Tell me which other country can say that they have 10 universities where students can design and tape out chips, actually manufacture a chip, actually fabricate a chip. So while the fabs may require much more amount than we have allocated at this point of time, the comprehensiveness of our semiconductor program will give us that edge which we require, which we need, and that will bring us to a level where people will automatically come, capital will flow to the place where the right place to absorb that capital is. So we are creating all those conditions by creating the ecosystem, by deepening the talent pool, and making sure that the market that we have, as well as the talent that we have, brings the capital automatically to our country. And that's happening.
A quick question about talent. India does not just have 1.4 billion people, but it has an extraordinary educational infrastructure and technology with the IIT system and beyond. Do you worry about the graduates who are still coming out of IIT in software engineering about what their future looks like in a world dominated by AI?
The IT industry is definitely going through a major change, and such changes have happened in the past also. I've been interacting with most of the IT industry leaders, and most of them have found a couple of methods by which this workforce can be utilized in the new AI world for providing solutions to the industry which are AI native, which are AI based. And yes, it will be a transition which will happen over the next few years. I think the industry is resilient enough to be able to manage that transition.
You won't find yourselves in a situation where tens of thousands, if not hundreds of thousands of graduates who thought they were going to have a job face a bleak future.
I think India will become one of the biggest supplier of AI services. That's what the IT industry people are saying.
We have an excellent question from the audience here on the subject of AI, Minister. The AI and the digital economy, as you said, really have no borders. How do you balance data sovereignty with an open architecture that itself is open to cross-border collaboration and innovation? How is India charting its own path there?
So, a good way to manage this situation would be to have trust relationships, trust-based relationships with like-minded economies, with like-minded countries, where the solutions which emerge out of such relationships are win-win solutions. For example, take the case of our payment system, UPI. Now, UPI has got Japanese patent. It's now being used in Singapore here. In many other countries, people are evaluating. What we have said is, fine, this is our contribution to the world. We don't want this to be seen as a solution which is offered in a licensed kind of way, in a commercial kind of way. We have given this as an open architecture to any country which wants to adapt, a rich country or a middle-income country or a low-income country. So that approach, which is trust-based and which is win-win solution-based, that works. That doesn't see boundaries, that creates solutions and good results for both this side of the boundary as well as that side of the boundary.
Do you see India as a user of other countries' AI technology, or do you see India developing its own AI stack that would be competitive with what we see coming out of the United States, for example, with Google, with OpenAI, with Anthropic, etc., or with the six little dragons in China, DeepSeek and the rest?
I think it will be both user as well as developer. See, if you look at the world of AI models, LLMs today, there are three different categories. One, large models, which are basically chatbots and providing summaries and that kind of stuff. Second, small, very focused models, which are used in very specific industries and providing that specific solution. This space is providing lots of opportunities for IT industry, for people who are developing applications, for people who are providing solutions. This is one space which is very important for India. The third is basically the new research which is happening. The phenomenon of providing large compute and keep on training the model to a level that is coming to a level of saturation now. Next innovation will come from some engineering or a mathematical innovation which will once again disrupt the AI model industry, AI model landscape. Where will that come from? We don't know. Question is, are we preparing our people for that? Yes, we are doing that. We have created a common compute facility of 38,000 GPUs, which is available to all the researchers, to all students at a price which is less than $1 compared to $2.5, $3 in the rich world. And that too, in the rich economies, it is dominated by certain big tech companies. Here we have equalized the access to technology. Our Prime Minister says that we must democratize technology. So that democratization of technology is what we have done. So that approach has given large number of opportunities to a very large number of researchers and innovators. Some innovation can come out of that approach also.
It's clear we all have a lot to learn about India. It's one of the reasons that we're taking the New Economy Forum to New Delhi next October. Minister, in the meantime, if there's one single misconception above all others that people, not just investors, although they're important, but that the world has about India and specifically its ambitions in technology, what would that misconception be?
I would like to take the question to a slightly higher level. People find it difficult to understand why India is growing at 6 to 8% band at such a consistent clip, and with moderate inflation, high growth, why India could achieve this kind of very healthy balance, whereas many other countries have struggled, especially after the COVID pandemic hit. So if you allow me 2-3 minutes, I'll explain that framework.
1 minute.
1 minute? Okay. So this framework is based on 4 pillars. First pillar is investment in infra, which is social, digital, and physical infra. Second is very big focus on manufacturing and innovation. Third pillar is huge focus on inclusive growth so that the entire society grows up together. And fourth pillar is very high level of simplification. 1,500 laws have been removed from the statute. So this very thoughtful, very carefully calibrated approach has given us a situation where we are going to keep growing at 6 to 8% for the next at least 5 to 7 years, I can see very easily, with high growth and moderate inflation. That is what India is going to be for the next many years. So, and that's a situation which every investor would look forward to, a situation where there is a stable policy regime, a lot of simplification happening, good growth, and very moderate inflation. So welcome to India for the New Economy Forum next year. I invite all of you to join us in New Delhi next year.
Minister Vaishnav.
Thank you. Thank you.
Thank you so very much. Ladies and gentlemen, we'll take a short break. Please return to the plenary hall at 11:30 sharp. See you then.
Please take your seats. Our program is about to begin. Please take your seats. Our program is about to begin. Please take your seats. Our program is about to begin. Please take your seats. Our program is about to begin. Please take your seats. Our program is about to begin. Please take your seats. Our program is about to begin.
Credit where credit's due, President Trump made a big bet that the US had a magnetic appeal, and that would enable him to get a better deal from US trade partners and companies that want to do business in the United States. On the evidence of the last few months, that bet is playing out pretty nicely. Economists don't agree on much. One thing they do agree on is that free trade is good and that tariffs are bad. For a moment, Trump escalated US tariffs on China all the way to 125%. If you plugged the US tariffs into a model of the global economy, what it said was that there was going to be a really significant drag on growth, and there was also going to be a significant upward impulse to prices. But when we look at what's happened to inflation over the summer, it's not come down, but it's not come up either. Why is that? It's because US importers and foreign exporters saw the Trump tariffs coming, and they rushed to front load, shipping to the United States before the tariffs could come into force, One thing that's happened is that we've gone from a lot of unexpected bad news concentrated on a single day to a series of country-by-country deals. They're something of a Swiss cheese of exemptions and carve-outs. The trade war is a drag, but it's not the only thing which is happening. We've got tax cuts with Trump's One Big Beautiful Bill, and we've got a bonfire of regulations which is stoking the animal spirits of US businesses. We've also got the artificial intelligence boom and a huge amount of investment going into data centers. Tariffs are having an effect. China's exports to the United States are way down relative to the historical trend. So, who pays for the cost of tariffs? Despite his well-known love of gold, the president is not an alchemist. He can't make something from nothing. That money has to come from somewhere. All of the evidence so far suggests that in the end, the bulk of it is going to come from US businesses and US households.
Please welcome to the stage Mark Coombs, CEO of Ashmore Group, Lim Hui Hua, Chair of the International Valuation Standards Council, and John Studzinski, Managing Director and Vice Chairman of PIMCO, for a conversation with Bloomberg's Francine Lacroix.
The music is absolutely fantastic. So Tom Orlik really explained some of the premise of what we'll do in the next half an hour. We have 30 minutes to try and address some of the fundamental questions around debt sustainability. What, if anything, drives leaders to confront the debt spiral? Who ultimately pays the price? How will these disorderly events in global debt markets reverberate through other asset classes and the broader economy? So I'm so delighted to have A-list panelists on with me. Mark, let's start with you. How much more tolerance do you think there will be for the U.S. continuing to expand its debt and deficit?
I think a limited amount from here. And I think, depending upon how things pan out, America is probably beginning to think about fiscally consolidating. If tariff revenues are as large as they might be, that could be 1% of GDP next year. And if that money is applied to reduce the debt and start fiscally consolidating, if they're able to create some level of Goldilocks, some level of growth, and they're able to drop interest rates so the debt service bill drops, they may not test that hypothesis. Ironically, I invest in emerging economies, and everybody tells me, they have much better debt statistics and dynamics than the US. That's all true. But depending on how the US applies this experiment, it might actually start fiscally consolidating. Subject to some of the stimulus in the One Big Beautiful Bill Act, you might find that the US starts to consolidate a little bit, which is given the huge expansion through the original Tax Act back in good old COVID, the 12 trillion of money that was pumped into their economy over the last 8 years would be quite interesting. So I think we may be at a point where the US may start to consolidate a wee bit.
Yeah, Lim Hui Hua, how do you see this developing? Again, the U.S. has loads more debt since COVID spending, since possibly, this big, beautiful bill, but foreign capital may also move away from U.S. assets. So does this feel like a recipe for disaster, full stop?
Well, I think many countries and many governments in Asia are trying to grapple with the level of tariffs in the country. And I think the fact that the U.S. has taken on more debt, I think it has led to a lot of U.S. dollar-related fluctuations, which I think many of the governments in Asia are also trying to grapple with as well. Yeah.
John, do we actually get to a tipping point? How do we know when we're at a tipping point, for example, for the U.S.? Mark's laughing over there because he knows the tipping point.
John knows it.
I think to level set this, just to remind us all, if we even look at let's start with the G7. we're at the same level of debt that we were at the end of World War II, from a global point of view. And the reason for that is, of course, the world took on a lot of debt. It was very expensive following the global financial crisis in 2008, and then subsequently the pandemic in the late teens. I think this is a chronic problem. I don't think it's an acute problem. I think the forest is smoldering, but we're not at the edge of the cliff. I think what we need to keep in mind is, and I have commented to Bloomberg that I thought that the title of this panel was a bit dodgy and that it was just debt sustainability. It actually should be debt sustainability and the global social contract, because what this is all about is governments around the world have a social contract, particularly in the developed world. And Mark and I were talking about it's emerging in some parts of the emerging markets where populations are aging, people are expecting pension, healthcare costs and the uncertainty of AI and how that's going to affect all these things are causing governments to have more expensive programs. And if we look at the G7, more than 60% of annual budgets are entitlements. And I think this word entitlements, it's one of those words that politicians don't like because it's like handcuffs. We can't do anything about entitlements. It's pensions, it's health care, and it's other type of social welfare benefits. But the reality is those have to be thought about in the context of how they're paid for. And it's interesting, Francine, we're here in Singapore where you've got this extraordinary model of having a government that set aside a very large amount of capital that has become, I think, 20% of their annual income as a result of having a sovereign wealth fund. So this is actually a very good test case for prudent fiscal management.
So there's a QR code if you want to ask questions, and I also am going to put all of the audience to work, so I have a polling question. But first, there's a first QR code for questions. Lim Hui Hua, do you agree with what John was saying?
Yes. Well, I think it comes really, well, I mean, it's not just the US. A lot of countries have taken on increasingly more debt. So it comes really at the expense of long-term infrastructure development, healthcare, education, defense, and welfare benefits as well. Yeah.
So to the polling question, because that kind of puts everything into context, although I will ask, Mark, where you see the tipping point for U.S. debt and what you're monitoring. But this is a polling question. So what's the most realistic way? There you go. This is a QR code. What's the most realistic way to break the cycle of runaway debts? And again, this kind of goes back to the idea that John was talking about for the social contract. So A, spending cuts on social programs, not very popular. And I know it's politics that is driving economics, but not popular. Major tax increases. B, also not very popular politically. C, legally binding budget caps. We may talk about the UK. And then D, investing in growth and productivity. So whilst everyone is voting on that, Mark, if we just quickly, briefly go back to U.S. debt, how do you monitor something happening on U.S. debt? Like, when do we know we're close to a tipping point?
The markets will tell you. I mean, if you think about what happened in April, there was a moment when the curve didn't behave quite like it should do, when there was a risk-off moment. There wasn't enormous amounts of buying at the long end. It didn't react exactly how everybody expected. And that's telling you that the markets were much happier staying in the short end, thank you very much, and looking to apply their capital when they felt other things were being managed. So the markets will be the first thing that tells you. And it's generally the markets that hold governments to account. For economies that are based on running deficits and having market access, if there's a hint of no market access, things tend to happen. Yeah. And it changes governments. You saw it even happen in the UK.
And the US, I mean, the Treasury auctions are still functioning in a very stable, if not robust way. So the U.S. government's access to finance is still very strong. I agree with Mark, but I would also say that you have to couple that with the word confidence of government. The markets pay attention to leadership and confidence from the, whether it's the Treasury Secretary or the Chancellor of the Exchequer or Finance Minister. It's a question of confidence.
Yeah, I was just going to say that the other signal would be when countries get downgraded by the rating agencies for the extent of public debt as well. Yeah.
Could we, but I mean, if you look at this like holistically, Mark, could other countries witness a Liz Truss moment? I mean, that was pretty ugly for bond markets.
Yeah, they definitely could. I mean, one of the questions in the UK at the moment is that we're about to get another one. They definitely, yeah, I mean, John's right. Confidence is what drives markets, and markets get ahead. They definitely could. If you're a country that's running deficits and relying on market access to do it, if you get a loss of confidence in your market, it doesn't just reprice it, and you get any kind of bias strike in parts of the curve. It's a real problem for you as a government running that deficit and managing it. We could definitely get that.
Do you think we
But the Liz Truss moment, actually, I think you don't have another Liz Truss moment. You don't have a dollar shock or whatever if you're anticipating it or you're trying to
You're ready for it.
I think also in the Liz Truss moment case, I think that was about a third Liz Truss and 2/3 LDI. So I think as a practical matter, I think you have to think about that going back to the markets.
Maybe. But those moments, as you say, once confidence is gone, you have a real problem. You do get a market shock.
But it's this combination of taxes, programs in terms of spend, including, as you say, defense, and how the government is, whether the government does or does not have borrowing capacity. And all those three, the market will have an opinion about all those three.
Yeah, I mean, markets have a lot of opinions. Lin Hui Hua, who do you think is at risk the most in terms of countries? Or, I mean, could we see a Liz Truss moment in the shorter term or medium term, and where?
Oh, well, countries at risk are the ones who are taking on more debt. I just want to make the point that there's a shortage of political will because long-term infrastructure expenditure doesn't square with the short-term nature of politics these days. And people are just, or rather political parties are just wanting to get re-elected for the next 4 to 5 year term. So they don't have the appetite to do anything that is long-term in nature.
And this goes to the polling question, which is interesting that 54% of you here in the room think it's investing in growth and productivity. That takes time, right? It's maybe something that in an election cycle, you sell it, but you don't actually see the benefits. John, and to your point, it's kind of what's needed.
Well, that's a secular.
Political will.
Investing in growth and productivity is a 5 or 10 year scenario, and people don't necessarily, people don't think about that, and that is certainly not the political cycle.
Yeah.
And I think that's the issue. And I think that the most interesting part of this whole panel is when you look back in history, the most innovative things come when you have a crisis, whether it was the Depression and Franklin Delano Roosevelt and how robust he was at all the programs that were put in place in the United States, or even in 2008, I can remember I was managing the restructuring there. You had the PBOC, the Treasury, you had all the major global banks and all the governors on the phone every Monday afternoon. And the world was very much coordinated. I don't see the world as coordinated today, and I think that's something to pay attention to.
So do you think if there was a big crisis, central banks wouldn't act together?
Well, I'm not going to say they're not going to be, because the world is going to hear my comment, and then people are going to say, why did he say that? I would say that I think there was a degree of chemistry and rapport in 2008. And remember, a lot of this is, and I just finished Andrew Ross Auckland's book, 1929. and he has a very profound paragraph in there, which he says, at the end of the day, there's a human factor which people believe the markets would never, ever disrupt or go down. They would always continue to rise. So I think the thing that comment, 2008, it was a group of central governors, all of whom liked each other, respected each other, and got on. And that's why it worked. This is still, in terms of all these issues we're dealing with, this is still about people.
And trust. Mark, which is most at risk? If you look at the US, Japan, France, and the UK, who do you most worry about?
Well, Japan has gone on the path to start consolidating. It's gone from 250% debt to GDP down 230%. So that's promising. Although we're about to see what comes with the new Prime Minister, and that sounds like we could have quite a big stimulus program. So is that consolidation going to continue? Don't know. But progress so far has been good from a high peak. The UK, I think, feels pretty controlled by the market. I think the UK is very nervous of the market. So I think the market is quite significant for them. So I think there's a chance that they do the right thing.
There's a big budget next. I mean, it's November 26th, so we're really a week away. What are you expecting from it?
Well, they've tried really hard to have it in public for about a month, like a sort of a little polling exercise. I think it is going to be some level of consolidation, but probably not as much as the market would like. So I don't think the market will be super happy about it. We are other countries with France and...
US.
Well, France is... I think the market's going to make EU rules, and the market is going to make France do some level of consolidation. The offset to that is that there's going to be a lot of European stimulus around defence and infrastructure built. So that will be an interesting level of where that comes from and whether the borrowing is French-driven or German-driven. In the US, as I say, I mean, obviously the US is the global reserve currency, and that gives it a lot of reasons and a lot of benefits. I think it really depends how big these tariffs are, what they do with them, what level of import substitution. So those tariffs get given to people's bank accounts, which is one thing we're hearing, more helicopter money. That, I think, is a bit of a problem and will add to the inflationary risk there. So it's what happens in tariff, and also what happens in productivity around the AI story. Some of that is short-term quite deflationary. You might get some inflation later on around bottlenecks in terms of the supply chain for the raw materials and power, but initially some of that's quite deflationary. And some of that seems to be having an impact already in sort of mid-level employment in the service industry, so it's quite quick impact. So the US, I'm always concerned about because it's big and ugly and everything has been priced off it historically. But it really depends whether they do get the joke and start to fiscally consolidate and stop kicking the can down the road and saying, we're fine, we can just issue paper. So it was very interesting 2 years for the US, I think.
Lim Hui Hua, can lower debt nations actually benefit in this kind of scenario, in this kind of environment? So where does it look safe? What about this nation, Singapore, which has a AAA rating? How much of a difference does that make?
Well, I think Singapore is still watching. Particularly between the US and China geopolitics, in terms of what new tariffs, and the tariff effects, because we're a trading nation. So we depend a lot on trade for our livelihood. Yeah.
John, how do you see this playing out across the world? Like what nations will benefit and the ones that you worry about the most that will lose out?
At the risk of repeating, just to go on what Mark was saying, the US and the UK operate on fiscal annual deficits. Germany, Japan actually have fiscal annual surpluses. France, the issue there is it's going to be a question of leadership, where there has to be some political conviction about where they want to take the country. But it has a lot to do with, there are certain parts of the world we're already seeing where robotics and AI are causing marginal disruption in terms of unemployment. So I think this whole question of social contract will become much more of an issue across the world, particularly if there's a spike in unemployment. I think longer term, let's just level set here. The US is still the largest economy in the world. It's the most liquid, it's the most transparent, it's the reserve currency, and it's going to remain, it's going to be there's going to be a continued challenge by other parts of the world to look at alternatives to the dollar, but there's nothing that's going to rival the dollar as reserve currency in the short term. The other question I should have answered earlier is, you said, when you look at very powerful economies, what's a good indication of an inflection point? In the United States, when the debt service cost exceeds the defense budget, it's always something to pay attention to. And that happened about 18 months ago. Now, when you mention that to the White House, the reaction is, well, we're going to increase the defense budget.
But John, I mean, the other thing is that you have big corporate giants like Microsoft and Airbus who basically can borrow at cheaper costs in their countries of origin. I mean, that really changes quite a lot, right? The perception of risk in there. And again, is this something that, what can countries do about that?
Well, I'm not surprised that the likes of Amazon and all that can get much cheaper debt because they are valued, on their own basis. But I think I'm just concerned about the increase in debt by many countries, and taking on of more public debt. And I think at some point it will have an impact on the capital markets as well, because you have financial instruments, real estate, they're all interconnected with capital flows.
Mark, when you look at the super narrow spreads on corporate bonds, what are they telling us about country debt?
You mean how tight they are? It means people are looking for other places to put money, and they feel that they may have a lot in underlying country debt. I think it's definitely people looking for other places to put cash and to try and get a pickup over what they see as very tight sovereign spreads as well.
Is there, John, in all of this, it's basically you need policymakers to be courageous enough to tackle this and maybe be straight with the populations about the social contract. Who do you think, is there some, are there nations that are doing this properly?
I think you only do this from this is like asking turkeys to vote for Thanksgiving or Christmas. You're not going to do that. This doesn't, it's a difficult thing. It's why it's never part of a political agenda, because people focus on this as a negative. You're going to cut healthcare costs. You're going to cut pensions. You're going to restructure. But I think if you look at countries that are dealing from a position of strength, we're now living in an environment where you do need to think about the demographics have changed. The structure of work has changed. People are working longer. The role of technology and AI and how that's going to affect the cost of healthcare and the role of insurance. All of these variables, the social contracts of a lot of these countries, particularly the G7, they were set 75 years ago. So it is time to proactively think about these social contracts. And I realize you can't do it in the middle of a crisis. And actually that's why politicians feel it's going to have to come from people who have a strong leadership backbone.
Yep. Well, policymakers are driven by what the politicians want, right? And so I'm a little pessimistic, because I think political will is in short supply at the moment. But what it means is that for the markets, for investors of the international markets, you need consistency in valuations, in order to make sense of what the underlying value is of each business. Yeah.
Or maybe, I'm sorry,
No, go ahead.
but maybe that's mostly true, and it's very important for big economies that they don't have huge crises. But maybe the way to really get change is a really big crisis, because then people within that country start thinking about, well, what is our social contract? We've hated our government, they're all terrible. I hate all governments. They tend to vote in somebody from the outside who, if they have some logical thing, can say, listen, we need to take some pain here. It's not my fault. We blame all the other guys. We need to start running a surplus. We need to cut government spending on government departments like that. And maybe that people, when it gets bad enough, realize that their social contract is broken and they're prepared to suck it up a bit to try and move forward. If part of the quid pro quo of that is democracy. And I guess Argentina is going through that now.
Yeah, it's an interesting comment, because we've had this debate a lot internally, and when you actually get different groups of people together, you almost think that this whole issue of the fiscal debt profile globally is something that's going to be resolved by a different generation of people, a much younger group of people. When you talk to Generation Z about this, they have a very different view of debt and the need to balance the budget.
Okay, we're almost out of time, so 2 quick questions each. First of all, how much do you worry about the growing popularity of private credit? And then if I give you $1 million each, well, Bloomberg will give you $1 million each. Where do you invest it, Mark?
Oh, boy. Thanks for that. Which one can I answer?
Both in 20 seconds.
Okay, well, let's focus on the $1 million. I always want to focus on the money. It depends on obviously on your timeline and your horizon. I'm busy qualifying my answer before I give it. I look for some level of stability in terms of environment and regulation. I try and look for some level of certainty in terms of policy, because I don't want to invest just day trade for 10 seconds. If I want to day trade, that's a different thing, and you follow momentum all the time. So I guess if I'm looking for growth, I'm looking for equities in emerging economies, and I particularly like some of the middle level emerging economies that are getting more scale and are busy building their own domestic consumption. What was the first question?
Private credit. How much do we worry about that? How much do you worry about that?
So we look at private credit in a slightly different way, I think, to the popular term, in that we think very long-dated private credit is actually a key part of growing the utility sector, the infrastructure sector of emerging economies. So private credit, particularly driven by pension funds who need long-term assets within emerging economies, is a great thing as long as you match the liability to the asset. So long-dated is good. Private credit, as it's sort of grown within the US and Europe, yeah, I mean, if any asset class that you're not marking to market and pricing, I mean, it's just very, very risky. And when the music stops, it stops.
Lim Hui Hua, where do you put £1 million? Or dollars? You can even choose your currency.
Well, I suppose it depends on ultimately the sovereignty of each country that I want to invest in terms of private credit. And across the different markets, I mean, equities and so on, then obviously the liquidity aspects would still be important.
John?
The question?
£1 million. Where do you put it right now? Where the social contract is holding?
I put it in a hybrid portfolio. I think you've got to look at high quality private credit. I call it private investment grade, really.
Wonderful. What a fabulous panel. Thank you so much for joining us. Thank you.
Thank you.
Thank you. Thanks for having me.
Please welcome to the stage Amy Braccio, CEO of Carbon Measures, Olav Svarva, Chair of the Board of DNB Bank ASA, and Mark Versi, CEO of Aviva Investors, for a conversation with Bloomberg's John Farr.
Hello. So yes, we are living in the age of Donald Trump, AI, geopolitical dislocation. And the urgency around climate that we saw a few years ago seems to have dissipated. Those of you who were in the audience yesterday morning for our audience poll will have seen that climate volatility, of all of the risks facing the world, in terms of what our audience sees as the risks facing the world, climate volatility ranked lowest of all the risks facing the world. So you'd be forgiven for thinking that climate had completely vanished from the outlook of investors in the world, but we're here to discuss how that's not the case. And it's interesting, I was looking at my Bloomberg terminal yesterday. The S&P Global Clean Energy Index is up 44% this year. That's nearly as much as gold. It's more than 4 times the return on the S&P 500, and it's even more than NVIDIA. So it's not like climate action or climate investment stopped while the world became transfixed by AI. There is a lot going on in the background, and that's what we want to dig into here today. But Ruth, let me start from you. You have come here all the way from Belém, where you attended COP. Can you just, before we dig into the investment perspectives, can you just give us a little sense of what was the mood like there? What was the sort of private sector involvement like? Tell us. Yeah. What was your accommodation like?
Well, I was fortunate with early planning. I was okay. So first of all, before I answer the question, I do want to say thank you to the Bloomberg New Economy leadership team for putting this on the agenda and on the plenary stage, because you would be forgiven for letting it fall down lower on the agenda, but it's so important. So they took in Brazil a different approach with respect to private sector engagement. And I think it's important to go back to COP26, when really the private sector was first brought in. And I think we all in this audience recognize the fact that we won't drive the change that we need if you don't have the collaboration between the public and the private sector. And with each subsequent year, it got closer. And so I think Brazil did a great job with a new innovation of standing up the Sustainable Business Cap. And they followed the model of the B20 and the G20, so that there was one strong voice from the business community where they had engaged with chambers of commerce around the world to bring it forward to the negotiators in a concise way. What did the business community think with respect to priorities? And the hope out of Brazil is that's a legacy that this presidency leaves, and that it gets handed off to the next COP presidency.
And in terms of private sector initiatives and innovation, what was the most interesting thing that you heard there while you were on the ground?
Yeah, so one of the things that was really interesting is that they did gathered people in Sao Paulo the week before to really bring together the private sector. A lot of the focus was on implementation and action. And so there was a lot of discussion about the fact that we are past the time of making commitments and more down to the concrete with respect to what is necessary to drive the transformation that we need. And I think the other thing that struck me was, just like the discussion we're having now, the private sector did show up for the conversations, and I think that's really important.
Yeah. So, Alok, let me turn to you on that. So, you run one of the biggest banks in the Nordic region, and one would be forgiven given the ESG backlash, everything else going on. You would be forgiven for thinking that companies had thrown in the towel on sustainability. What are you seeing on that?
Well, they're not, absolutely not. I mean, we see that. There is a backlash, but the companies are really adjusting and have high on the agenda the sustainability, and they cannot afford not to do that. But it's a reset, and the companies have had to adjust to the fact that the policies have been changed in the US, as you showed too. Downscaling there. In China, you have seen tremendous growth on renewables. And then in Europe, it's more like in the middle. We did have the Green Deal. Now it's more on competitiveness. So companies have had to adjust to that, and also have to adjust to what took place, with the ESG hype, if I may say, where investments have been, haven't given the return in the real economy as expected. So we see that the companies that we follow, they do have sustainability on the agenda. It's more back to the fundamentals to see how can How do you have the business models that are resilient, that take into account the risks and the opportunities within sustainability? So that is very much, I think we will see more longer-term effect. So it's a reset for the companies. And investors, they expect the companies to do have a sustainability strategy. We had done a survey with leading investors in Nordic, and they all expect the companies to have sustainability and ESG on the agenda and have specific targets. And we as a bank as well, we expect the companies to have a prudent long-term transition strategy. So very much on the agenda.
And just for the benefit of our audience, could you give our audience a sense of the universe, the geographical universe of your client base? Is it mostly Nordic companies? Is it mostly European companies? Because that sort of rings true, but I'm sort of wondering, does that also apply to US companies?
Yeah, well, we have a Nordic banking, but we are leading into sectors that is important for the Nordics. So we have a global leadership in renewables, energy, shipping, ocean services. So these are companies that also invested globally. So, and yeah.
Before I turn to Mark to talk about investing opportunities, Ola, perhaps can you tell us a little bit about what lessons do you think we've learned over the last 5 years? 5 years ago, there's a lot of talk this week about AI bubbles. 5 years ago, perhaps now in retrospect, we were seeing a green bubble. What have we learned since then? And how can we apply that going forward?
I mean, it's a good question. It was, we have to say today, in retrospect, it was a hype. And we have to remember interest rates were low. The policies were quite clear that we should have a green transition. And companies were very optimistic and saw the opportunities. Investors, we didn't have sort of the... we're not critical enough, so it was over-optimism. So always lessons learned from that. And then interest rates came up, inflation came up, and it was, we didn't get the effect from the investments in green solutions as we should have had. So lots of loss.
Lots of lessons.
Yes.
Mark, before we talk about the lessons, what are you're the investor on the panel. Where are you putting your money and why right now?
Well, first of all, just to say Aviva, I'm the investment arm of Aviva, but Aviva as a global insurer, climate change is existential risk to an insurance company. So, I mean, it's definitely never been forgotten from the insurance sort of mindset. But the reason to have faith in investments is there's so many different places to invest. So for a long time, we've been investors in renewable energy. We're one of the largest financiers of offshore wind in the UK. But we've been shifting more recently to the demand side of the equation. And in particular, we're looking at decarbonizing industry. So we invest in infrastructure that actually goes on site onto industrial plants, so providing solar, battery energy storage and batteries, heat pumps at industrial scale, saving heat as well as energy if they're creating extra heat, electric vehicle fleets. So actually decarbonizing the light industry is actually really investable right now. And why does it work is because we are getting a long-term contract from the industry, which is what we're looking for as financiers, but it lowers the cost. It's simply the maths. The finance works. It does lower the cost of those industries. It also creates energy price stability, which is something the industry is incredibly focused on, particularly across Europe. So we're seeing quite a lot of demand now for that kind of infrastructure. So moving not from just the supply side to the demand side too. And then in the venture space, there's a lot of focus on climate tech for the future. It still, has yet to be proven to be investable at big scale at the at sort of my more pension fund side of my business. But as a venture business, it's really showing some great green shoots.
By that, are you talking about hydrogen, carbon capture, that sort of frontier tech?
Yeah, more the carbon capture side, I think. I think hydrogen still needs a lot of support from governments. It's definitely not investable at scale when we look at it from the institutional side, but it's coming. We don't need it for the sustainability journey, maybe for 10 years or so. So there is time. And that's why, as a good venture investment, then you need to spread your risk across multiple companies. But the winners will get the follow-on rounds of funding, and then eventually, then they'll get the big financing, like we do now for offshore wind, in the hundreds of millions for every ticket that we write.
I know this is a very, very broad and perhaps unanswerable question, but when you look at clean tech or some of the other infrastructure investments you're making, like in large-scale heat pump deployment on an industrial installation, what kind of returns are you looking for, or are you getting?
Yeah, so for decarbonising industry across Europe, then we should be able to get an 11% IRR fairly straightforwardly. So that's really good for long-term pension scheme investors. It's relatively low-risk investment, so it's not the early stage at all. This is proven technology with long-term power price contracts from industry, and these are big names in industry. So it's very, very credible investment strategy.
If there are investors, people in the audience looking for a higher risk opportunity, what would you sort of point people towards? I mean, carbon markets have sort of been on the dawn of carbon markets for a long time now.
So carbon markets are working. So we have a carbon removal fund. Right now, most of our focus is on nature-based solutions, and a lot of the value being created is in the carbon markets. We're starting to see investors starting to look at a fund like that rather than just for offsetting purposes to get those carbon credits to offset their own carbon emissions. We're actually starting to see investors look at carbon as an asset class because they think the price is just going to keep going up. So actually, why not invest and get that diversification, looking at it as a completely different asset class? So, but right now it's more nature-based. That will have limited capacity. There's only a certain amount of land that can be used. Then we move on to engineered solutions. At the moment, as I said, that's more venture. That's where the higher returns are, of course. But the large scale yet to come in that sector. We need a lot of government support still in that sector.
Yeah, we're going to get back into the government, what governments can do in a minute. Carbon markets, of course, are famously fragmented. Is there a particular carbon market where you're seeing most interest right now, if you look at it globally?
Well, I think Singapore is one of the great jurisdictions of leading the way there. So the UK, it's working. You can now get accredited carbon credits. You need the true carbon credits, where it's actually carbon removal. I think there's now a very good independent verification of that, and Singapore is right at the heart of everything going on there.
Ola, it's not just about renewables, of course. It's about lending and transition finance. When you look at your books, is the demand for transition finance growing, or is that sort of steady at a low level?
Absolutely, it's growing, and we see great opportunities there. And we as a bank, we have taken a position to support all the customers in the journey, in their transition journey. And we have many hard-to-abate sectors, like energy, shipping, and we see a great demand from our customers into transition finance. So we have said that we have set a goal on how much we want to invest in transition. So it's 150 billion until 2030. And the point is that when we support our customers, that's part of the transition finance, is that they commit to certain achievements on, for instance, emissions. So the price on the products or on the loans is connected to the companies achieving certain KPIs. Also we have into the corporate bond market. It's big in the Nordics, and over 30% of the corporate bond market has a sustainability link to it. So it's very popular, and again, we support customers in the transition. not only with capital, but also with competencies. So transition, the brown and gray to more green, that is an important responsibility we have, and we say that we want to be a driving force in the transition. And it's very, many companies take up these loans.
Roughly what percentage of the loans that you give out are transition finance right now?
I would say that the transition finance around 800 billion. So we're halfway to our goal to 1,500 by 2030. And again, the corporate bond market, that's around 30%.
Okay.
We're seeing a lot of green loans in real estate now, actually. So if a real estate owner will agree to lower the carbon footprint of the building, we'll actually build in a lower rate for them on the lending. And the reason that works is because actually the energy efficiency of the building is going up. So it actually becomes a better quality building. So it adds value to the building. So it's actually the correct...
Over time you spend less running the building.
Running the building.
Yeah.
So it's cheaper to run, which people then want to rent it more. So it increases the value of the building. So the lending can actually be offered cheaper. So
what's the differential roughly? I mean,
it's probably about 20 basis points, something like that. But that's actually quite meaningful over a long period of time for these borrowers.
Yeah.
If I can add, for instance, give you an example on shipping. We see all the ships out there in the bay, and the shipping sector, they account for around 3% of emission. That's a lot. And supporting these shipping companies in their transition is important, so that the loans could be used to specific technology that reduces fuel, reduces emissions, or open up for more sustainable fuels going forward. So I think, work with the shipping, with the industry, supporting them in the transition, that is very important going forward.
Because climate is a story in many ways about market failure, about imposing the negative externalities of capitalism get imposed onto the rest of society. And it's also an area where we still need government support to get things going. Mark is an investor, Oleg is a banker, but you're a non-profit. Carbon Measures has a very specific approach here in terms of dealing with market failure. Can you tell the audience a little bit about what you do and how Carbon Measures tries to address that?
Yeah, absolutely. So Carbon Measures is brand new. We launched on October 20th. We're a business-led coalition where we brought together industries from around the world and across the value chain. So we have energy companies, we have steel, we have chemicals, we have financial services, we have public accounting, we have transport across the board. We've got strong coverage and we're looking to grow. But the problem that we're trying to solve is one of the demand side, like you talked about. And so while there are now some signs showing that emissions will start going down at some point in the future, we know that it's not fast enough. And we also recognize that the world still does need more, whether it's infrastructure or it's homes where your electricity reliably turns on or it's data centers, that demand is going to keep going up. And so what we're looking at is how do you align the market incentives to the actions that need to be taken in order to drive down emissions. And what we find too often is that there's amazing innovation, but these startups can't find or indicate that they have sufficient demand on the other side to get the investment that they need, or large companies are investing in low carbon solutions and again don't find the demand on the other side. And so if that's the case, we're not going to get the investment and we're not going to get the transition. So what we're looking at is two things that we think need to be done in order to create the conditions so that there's better and more durable demand. The first, and forgive me, I'm a CPA, so it's a little bit nerdy, but the first is that we need carbon accounting that draws on the principles of financial accounting and science so that we rise up to the level of a generally accepted approach to measuring carbon emissions at the product level. What that allows for is comparability and it allows for companies to differentiate their products so that they understand that if it's a ton of steel from company A and a ton of steel from company B, you can do the comparison to understand what you're buying. But better data alone is not going to drive demand. And so you need regulation in addition. And so what we're focused on is product level regulation and product intensity standards. The reason why we're focused on product level is because it has worked. So if you look at how we solved the ozone layer issue, how we solved products that were driving acid rain, we all have seatbelts in our cars, like this works. And so we think that if you have the combination of the precise accounting that allows product differentiation and a target at the product level that companies have to hit, you now get market recognition for driving down emissions.
But those products, I mean, I don't think the Trump administration will be imposing carbon intensity standards anytime soon. So you need, for this to actually happen in the real world, you need big markets to actually impose those standards, apart from the US. Where do you see that happening?
So you already see some level of focus on intensity standards or product level regulation. So we've got CBAM coming on board. It's different from what I described.
Maybe tell the audience a little bit
about
CBAM.
Yeah, so CBAM coming out of the EU is the way to make sure that you're not allowing for carbon emission leakage, right? So that you've got regulation in the EU, but if you don't have a mechanism to make sure that it's just not, the emissions aren't offshored, that's what CBAM has been put into place to address. So that's a product level regulation. Out of China, you've got intensity standards that are coming on board. And one of the things that would help from a private sector standpoint is to drive more harmonization with respect to how the regulation is done. So I'm not saying it's going to be an easy or a overnight journey, but we do think it's one that can be accomplished.
And companies are going to have, I mean, two examples you mentioned, China and the EU. Companies are going to have to think about this, right?
Yeah, absolutely.
Yeah. I'd like to talk a little bit about government as we come towards the end. Mark, what more, and please everyone feel free to jump in terms of crowding in private sector money, what more work do governments around the world need to do, or where are you seeing maybe the best examples of that?
Well, I'll start with the UK. I sit on the Net Zero Council of the government, and that's an initiative which brings together finance and industry together with government to help create a policy environment that is conducive to investment. So the UK's just launched its carbon budget delivery plan with very stretching targets for it to hit. But there's various areas of focus that are really going to drive future investment. So homes is probably one of the biggest. So new homes in particular, standards they're going to need to have so that new homes have heat pumps, have solar, as many places they can. So if that sort of policy can be brought in, that will be a game changer, just like it has been for electric vehicle where policy is brought in. I think that stability, long-term commitment that you need from government in order to get long-term investment in is absolutely critical. So we've spoken about the EU and the UK. I think that's where, for long-term infrastructure that links to renewable or to decarbonisation, that's where a lot of the focus is right now because of just that government focus that's there. They're going to have to do a lot of work on heavy industry. Now, that is going to be where carbon capture and underground storage comes in. I think those hard-to-abate sectors like cement, like steel, they will need a lot of support from governments. And that will probably be of some sort of incentive or tax incentive if it's not sort of direct incentive. And then to crowd in, then most governments have now got lots of wealth funds which are looking at taking that first loss risk, which is essential again, particularly if there's technology risk involved. So an insurance company like Aviva is not ready to take on large technology risk. We want proven or relatively proven revenue streams. So this is where government can come in and take that early stage risk or take the first loss risk. And then we can then be crowded in with large amounts of finance that can come in on top of that. So the combination, the blended finance that's then created, can actually make a difference.
Is that happening? Are there concrete examples?
It is happening, yeah.
Or you can jump into
yes,
it. Yeah.
Echo what you say there. One additional point is that the policies, many of these investments are very long-term, lots of capital, and then you cannot have sort of surprises in policies. You do need to have long-term. For instance, in the U.S. on offshore wind, where the federal government had stop order in the middle of a project of offshore wind, of course that is devastating. So not what government can do, but what they should not do. So have long-term policies, that is important.
Mark, you touched on the insurance industry at the top. My previous job, I ran Bloomberg Green, and we wrote a lot about the uninsurable planet. Mm-hmm. Where are you, which parts of the world do you worry about most in terms of the insurance industry pulling out, and what does that mean for long-term investment?
Yeah, so a lot of insurance is obviously linked to weather.
Yeah.
And so housing in certain parts of the world is becoming very uninsurable right now. At the moment, a lot of insurance companies will still insure because they can reinsure the risk away. So it'll be the reinsurance market that cracks first, that says, no, we're not taking on any more risk of a certain region from flooding or from fire or from storm damage. So when that reinsurance market cracks, then you will suddenly see, huge increases in pricing of home insurance. And then, the population, winning the hearts and minds of population is one of the hardest things in addressing climate change. But as soon as prices of insuring your home goes up, then you're suddenly going to have a lot of people wanting that'll hurt their pocket.
If you had to guess, where do you think the reinsurance market might crack first?
I think it'll be flood risk. That's where we're seeing it. But the governments are already having to step in and create schemes themselves. So even in the UK, we have a flood reinsurance program which allows communities to still get insurance. Without that, the insurers almost certainly wouldn't be insuring certain areas.
Yeah.
One thing that will be interesting is litigation on climate damage. So we are seeing more lawsuits coming in, actually attacking corporates who they're claiming are creating climate damage. So that is covered at the moment in insurance policies. So the director and officer insurance. So again, if the reinsurance market starts to say, well, hang on, we're not going to start insuring that, then you're going to find it harder for directors and officers to get insurance. And then, of course, all the boardrooms will suddenly be a bit more focused on the risk that their company is creating.
Yeah. I have one question from the audience, which any one of you is free to jump in and take. What are the views of the panel on the role of nuclear energy for meeting the combined challenges of climate mitigation and energy demand? Is nuclear, is it an interesting investment opportunity right now? Are you seeing any lending for nuclear projects?
We are not into nuclear. Norway's oil and gas and renewables. But in Sweden and Finland, you do have, of course, that energy source. But that is a very long-term horizon for nuclear to be an energy source. I don't know if you are investing.
Yeah, so the UK government has just committed to a whole range of small modular nuclear reactors. So it's coming in the UK, and obviously Sizewell C is now underway. The financing rounds are starting, so it's going to be a big question that we're going to be looking at. But I think from an pure investment standpoint, it should be quite attractive.
Yeah, okay.
And I'll just add different countries have different access to different mixes of energy. Right. And so I think that we've got to look at all varieties to meet the needs of communities, and whether it's incorporating carbon capture to make sure that we're addressing emissions, or it's nuclear, it's solar or wind, we're going to really need all of in order to meet the demand.
Ruth, I'll give you the final word. I think, Mark, you're based in London. Oleg, you're based in Norway. You are based in the US, which is sort of ground zero of the backlash on climate right now, it seems. In this sort of weaponized era that we're in, how do we talk about climate and climate investing in a way that doesn't make people run for cover right away?
what I find is that when you put it in the terms of business, it becomes much less controversial. And so organizations need to think about what are the risks that they face that they need to mitigate. How is the demand from their customers changing? And no matter where you're based around the world, if you've got customers based particularly in Europe, you're getting different demand signals than you have in the past. And then what are your opportunities for growth and differentiation related to all of the, the energy transition opportunities that we just talked about? When you put it in those terms in the language of business, there's much less pushback.
Well, on that pragmatic note, thank you to my panel. We're out of time. Thank you.
Thank you. Thank you.
Thank you.
Please welcome to the stage Jonathan Feiner, former Principal Deputy National Security Advisor for the United States of America, Tammy Tam, Editor-in-Chief of South China Morning Post, for a conversation with Bloomberg's Tim O'Brien.
Thank you all for joining us. There are a lot of theaters of conflict, diplomacy, economic competition, and warfare afoot in the world right now. Eastern Europe, the Middle East, and it's relatively cold given what's happening in those zones here in Asia, but nonetheless there are a lot of existential and monumental issues afoot, and so we are going to focus, given that we're here in Singapore, on APAC. I'm joined today by a former journalist and a current working journalist. I'm a journalist. Journalists know a little about a lot of things and nothing all at once. So with that in the mix, I wanted to start with you, John. And do you think the term national security is an oxymoron? And is it more proper to think about it as international security in the era we're in, and is there a lesson to be drawn from that, given where we are with, notably, given that we're here, the China-U.S. headbutting?
Yeah, look, it's a good question. I think whatever term you use, the notion that a country can be secure either physically or economically simply by retreating behind its own borders, building high walls, doing everything itself and kind of hoping for the best, I think has been totally obliterated by history. Unfortunately, in my country, there are a number of people who seem to want to revive what was a tradition, I think, that was best left in the past in the United States. And the reality is, if you try to implement that sort of approach, problems around the world have a way of finding you, and your quality of life ends up lower than it might otherwise be. So I'm against that way of thinking, but it is a debate that's active in the United States right now.
How do you see that sorting itself out?
I think, unfortunately, there are probably going to be some negative effects felt by that approach if it makes its way into policy, and we will learn our lessons and self-correct the way we always have. The United States does tend to be pretty good at having made mistakes, learning from them, and moving on and improving.
Tammy, right now there's a lot of economic and quietly militarized headbutting between China and the U.S. In an ideal world, I would love to see both of those issues resolved. But am I naive? How do you think directly this will play out in the near term between China and the U.S.?
Okay, thank you very much, Tim, for having me here. You mentioned this national security, what is international security. I'm a journalist. We try to look at more facts and look at different perspectives. So as a journalist, I'm not a commentator, so I'm not making kind of like a comments. I'm trying to share with our audience my observation as a journalist because I've been able to talk to many newsmakers, policy makers, policy shakers. So when it comes to this, the national security versus international security, whatever we call it, I would, and John, you just mentioned the border issue, whether you need to build up a wall or something. I would like to share one or raise one little quiz to everyone here. Are we aware of how many countries that China bordered with? It's 14. 14 countries directly bordered with China. From the north, up north, we see Russia, North Korea, Mongolia, and then we see in the Central Asia part, we have Kazakhstan and some of these are Central Asia countries. And in the southern part or southeast part, we see India, Pakistan, Afghanistan, and I try to refresh my memory to just mention a few. Nepal, Laos, Vietnam, 14 total. So when it comes to national security, whatever it is, I think for China, if you talk about China and the US, first of all, China is a part of Asia. It is in Asia. And with a 14 country surrounding it, I think for all the reasons China wants to have a peaceful coexistence with all these countries, not to mention the whole Asia, because China is the biggest country in Asia. Any conflict in whatever format will affect China's own stability and China's own interest. And then when it comes to the US, we are now talking about these are the two big elephants in the room when it comes to Asia. For the US, of course, the US has a lot of interest in Asia as well. And the US is the world's biggest power. That's undeniable. But for China, this is where it is. So I put it in this way through my team's coverage about China and the world, China and Asia, China and EU, China and the US. I think there's every reason when China wants to maintain the kind of like a more peaceful environment in Asia, and by working at least to reduce conflicts or to handle any differences between China and the US. I do see this national security tightly tied to, actually another term better described it should be national interest. Every country has its own national interest. So US has US, China has China's, all the other Asian countries has its own as well. And Asia is so big. When we talk about Central Asia, Southeast Asia, Northeast Asia, Korea and Japan and all this, so different areas, actually they have a different interest. It's all a matter of let's trust in the wisdom of leaders from different countries to try to properly handle differences and try to find common ground. This is how I see it.
So Tammy, in the context of China wanting to have peaceful relationships with its neighbors and finding common ground, over the last 10 days or so, there's been a very sharply worded exchange between Japan and China.
Yeah.
Because China voiced its concerns about the fate and future of Taiwan. And Chinese officials responded with very strong language aimed at Japan's new prime minister that didn't come across to me as neighborly or an olive branch in the hopes of future peace. Am I just reading that too much like an American?
I think China-Japan relations, eventually there's also an American factor, US factor there. It comes to the crux of the issue. Actually, it's about Taiwan, as Tim, you rightly pointed out. Anything between China, we all know why this latest spat happened. It's because of Prime Minister, the Japanese new Prime Minister, some comments about Taiwan. And Taiwan, we all understand, is the red line, uncompromised red line for China. And so the whole thing actually is about Taiwan. But for me, according to my interactions and my observations by my interactions with some of these experts, including some officials in Beijing and in other related areas, personally, I don't think there will be an imminent kind of a threat for any military clashes over the Taiwan Strait. It's only that China or Beijing must make it very, very clearly Taiwan is China's internal matters, and any foreign inappropriate interference into the Taiwan issue is something that Beijing cannot accept. And I think for the U.S., maybe John, you have better ideas. I think the U.S. government, after China and Beijing, they signed these 3 joint communiques, which enable the normalization of China-U.S. relations decades ago. That 3 documents have been the major reference for Beijing when it looks at the Taiwan issue. And U.S. presidents, many presidents, have been quite cautiously not to cross the red line. And one thing very interesting, I think maybe John, you have a better interpretation, is that during the latest summit between President Trump and President Xi in Busan in Korea, President Trump did not even raise the issue of Taiwan. I still remember that day in my newsroom, we were talking about how to cover this, the summit is such a big news. And then eventually, oh my God, they did not touch on Taiwan. So in journalism, sometimes something happened. Of course, it is a big news. Something that was omitted can be a bigger news. So why President Trump did not mention Taiwan? Probably he wants to focus more on tariff and the
We'll jump in on that, John. Is that why Trump didn't mention Taiwan? Is because he wanted to focus on tariffs?
So it won't surprise you. I'm not closely consulted on the preparations that the White House and President Trump made for this meeting. There was, as everybody knows, a lot of speculation in the run-up to that meeting about a whole wide range of issues that might be covered, possibly the lifting of significant U.S. export controls on advanced semiconductors. That didn't happen. Possibly some shift in U.S. doctrine or policy when it comes to Taiwan. That didn't happen either. By the way, I think those are good things from the perspective of the United States, that there weren't changes made in those areas. But this problem is not resolved. I think it's safe to say. I do think, they bought some time now where the temperature is lower than it was, but there could be as many as 4 meetings between these 2 leaders, or at least 4 instances in which they'll be in the same place. Probably a visit to Beijing, probably a visit to Washington, APAC, G20. So, each one of those is going to have these same set of issues come back to the fore, some negotiations in advance between the 2 teams about what the outcomes will be. These meetings are always carefully prepared. So there are going to be more opportunities, I think, for this to be discussed. And, it's just the first year of the second Trump term. There's a lot more to come.
Apart from Taiwan, which is apart from a very big thing, but it's useful to consider this recent kerfluffle with Japan over this, because a number of Asian nations right now, whether it's South Korea, the Philippines, Japan, obviously, Australia, are all having to grapple with what is something of a vacuum in terms of how to understand where the United States, which I think has become an unpredictable and unreliable ally in terms of national security or international security issues. And they're trying to navigate how to fill that gap. And I think Japan decided to enter it with a very strong voice We've heard strong statements from Singapore this week here at the forum. Is that the route? Is that the best route for Asian nations to go in this environment?
Yeah, look, it's a strange predicament in some ways to be a U.S. official, or in my case, a former U.S. official coming to parts of the world like this and talking about what's happening. Because, not that long ago, our disposition, which was probably a bit condescending, would be to come and tell you about all the problems that are happening in your region and what we think you should be doing about it. Now, I often find when I speak at events like this, I'm requested to explain what's happening back home and maybe getting some advice from people here about what we should do about it, which is a different sort of position for the U.S. So I have a lot of humility with what I'm about to say, but so I'm not really in a position to tell countries here how they should be handling us. But I will say a lot has changed in a relatively rapid amount of time. Whatever you think of the Biden administration's approach to Asia, and I'm not naive enough to believe there are not critiques, including maybe some similar critiques to what you hear about the Trump administration. The one thing that we would say to countries in this region and elsewhere is that we're not asking you to choose between the United States and China, but we do feel very confident about the value proposition we offer to our partners. We may not be able to waltz in and write enormous checks and revamp your country's entire infrastructure, but we are a reliable, predictable partner. We play by the rules. We stand up for the rules in the international system, rules that have helped, I think, this region maybe more than almost any other become
But you think that's how the U.S. is perceived right now?
And so that's what I was getting to. And I think that is something that has changed dramatically. I think today the country that probably more than the United States is trying to make that argument is actually China. And that is a big strategic shift. It's a big strategic, I think, disadvantage for the United States to have ceded ground on issues of rules, because we are the ones now taking aggressive actions, including with our partners and allies when it comes to trade. We are the ones also taking some significant actions when it comes to the use of force in our own region. I'm talking about now in the Caribbean and the Eastern Pacific, that call into question our commitment to rules that have been in place for decades. And so, I do worry about that, and I do think it's possible that even future U.S. administrations, depending on how this plays out, may draw lessons that some of this actually works, and I think that's maybe the scariest thing of all.
And works in the context of disrupting the status quo?
Works in the context of actually extracting from partners and non-partners significant concessions that, at least in the near term, may be seen as benefiting the United States. If the rest of the world responded to the Trump trade approach by saying, we're just going to let you commit self-inflicted wounds and you're going to do whatever you want and we're going to continue to behave and operate as we were and not going to step forward with a bunch of concessions, that would have one lesson that it might impart on American policymakers. But when countries come forward and say, actually, we're willing to do this and that just to get off of this incredibly high tariff situation, I think, that will lead to different lessons, including by future administrations in the United States.
Just a reminder that we can take questions from the audience if you have them. I'll see them on my iPad and dutifully try to get to some of them. Tammy, how does China view the Trump administration? And do you think they have clarity on how best to secure China's own interests in the Trump era? Or do you think they're off balance themselves?
Well, I'm very glad that John just mentioned that when you talk about, we are not asking the Asian countries to pick sides. I presumably you mean the administration, right? Whoever is the president. I think this is, for China, as I just mentioned, China is part of Asia. It is here. And China is with all these neighbors, all these Asian countries, and China now is the world's second largest economy, unavoidably, and China is growing, and China has very close trade ties, and everything with all these neighbors. They must work together. This is the reality. And then the U.S. is the superpower. So Asian countries, for all the reasons, they must handle this too. But I think for China, whether China is well prepared in dealing with President Trump, especially President Trump's 2.0, I think now China is much better prepared comparing with Trump 1.0. The thing is, I do believe Beijing leadership, whoever who is sitting in the White House, Beijing still wants to maintain relatively peaceful relations with the U.S. I think President Trump, a couple of years ago, when he met President Biden, he mentioned China-U.S. relationship cannot be, it's impossible for China-U.S. relationship to go back to what it used to be years ago, decades ago, which means it's relatively quite peaceful. But with joint efforts, the two major powers, they should be able to forge better future relationship. I think that it's only good for China, for bilateral, and for Asia, and for the whole world. If these two superpowers, they can forge a relatively peaceful relationship. And I also find this this kind of theory, whether the number one will contain the number two, or whether the number two will be the number one. From all my conversations with all the Chinese academics or officials, I get this impression: China does not want to be the world's number one. They're very happy to play as the second fiddle, and to be the number one. It's very costly, and China is far from ready for that.
But it sure seems to me like both Trump and Xi both want to be number one, I have to say.
In terms of
I don't see either one of them being content being number two.
Yeah.
And I think that's part of the reason we're seeing trade conflicts and questions about military confrontations.
May I chip in here? I think there are quite some similarities between President Trump and President Xi. President Trump's slogan is to make America great again. And for President Xi, when he stepped up to be the leader of China in 2012, his slogan has been always to realize the rejuvenation of the Chinese nation, which means that China should grow and should be a strong nation. But it doesn't necessarily mean that China wants to be the number one and overtake the U.S. Actually, honestly speaking, there is a big gap between China and the U.S. in many fronts. That's also the reality, even though China may...
But to its credit, China's closed a lot of those gaps, and it's intending to continue to do so. How do you read that, John?
Well, look, I think this is a fundamentally competitive relationship between these two countries. I think there are times when leaders, actually, to be honest, more so Chinese leaders than American leaders in recent times, have wanted to downplay the notion of competition between the two countries. But I think the reality is this is a competitive relationship. But it has to be a relationship in which the competition takes place within certain constraints and certain safeguards, because it would be a disaster for the world and for the two countries themselves if this competition were to tip over into conflict. And so that means diplomatic relations are important. That means when it comes to trying to address big global problems, like climate, like global health, like the collaboration the two leaders talked about when it comes to drugs and fentanyl recently, that they are able to work together. But, you know, the United States is pretty clear that we will take seriously the competition with China when it comes to technology, that we consider this region a strategic priority for the United States. We will have a significant military presence, significant economic relations with the countries of this region. And I think we feel good over the long term, whatever administration is in office, about the prospects of the United States in a situation in which the rules are fair and both sides are adhering to them, will be able to succeed in that competition. I think China probably feels the same way.
We have 8 seconds left, and the clock is ticking. Tammy, really briefly take out your crystal ball and tell me, in an ideal world, where will the Asia-Pacific relationship with the United States be a decade from now?
Well, I don't have a crystal ball. Just imagine that I have. I mean, I absolutely agree with what John just said. I think in the near future, China and U.S. unavoidably there will be competitions in many fronts. But if we can, the two leaders on the two countries can manage it in a way, and just take this AI, for example. We are all talking about AIs, and I do see that China and U.S., actually they can work together about AI governance, at least for civilian uses. And that will be one way for the two countries to make great contributions to the to the world. So in 20 years, I cannot predict the future, but that's my hope. I do hope these two countries, they can find more common grounds than escalating differences.
John, really quickly. Sure. So the United States is about to celebrate its 250th anniversary as a country. We often get told when we come to this part of the world about the ancient nature of civilizations here and the lessons that should be drawn. The lesson I draw from American history is that we may be going through a difficult time right now in some ways, but we've gone through difficult times in the past. We've had a civil war. We've had significant political violence in the United States in the not so distant past. And the United States has demonstrated, I believe, beyond what any other country on earth has shown, an ability to learn lessons, to course correct, and to keep moving forward. And people that have bet against that historically have been wrong.
John Feiner, Tammy Tam, thank you for joining us today.
Thank you.
Ladies and gentlemen, that does it for our plenary program here on day 2. We'll do it again on day 3. Look forward to seeing you tomorrow morning. Quickly, it's time for our breakouts once again. Same instructions as yesterday. Head to your breakout, the ones you signed up for, that is. Grab a lunchbox before you enter the breakout room. If you have not been to a breakout yet, there's still some space. You can sign up, head upstairs to the 3rd floor, top of the staircase to the registration desk, and see what's available. I encourage you. The breakouts are some of the best and most important things we do here at the New Economy Forum. The first breakout started about 1:15. Our second round of breakouts, as you can see behind me, well, they should pop up in a minute, start at about 3 o'clock. And for those of you who have chosen not to sign up for a breakout, you'd like to have lunch, there are a number of lunch options. Again, they're the same as yesterday. You can go to Fiamma over here on the terrace or beyond the terrace. That's a restaurant. You can have a sandwich and salad lunch. Boxes are available in the networking lounge just across the way here. There's also Singapore House in the networking lounge. Or you can head upstairs to the 2nd floor to Bob's Bar and the terrace for a buffet lunch. I hope you enjoyed the plenary. Head off to your breakouts, and I'll see you tomorrow.